It's an important meeting today, and unfortunately, we're going to try to keep the agenda moving. Good morning, Mr. Secretary, Madam Auditor, Treasurer. Good to see you here this morning. Director, good to see you. Just at the outset, let me say that really appreciate people being able to be here today. I think we'll have some folks on Zoom joining us. I see Representative Stith online. Ben Bump will be running Zoom. Today, I'm going to try to keep the agenda moving with the grace of my committee members. If they don't have any objections, we'll try to move fairly expeditiously through this. Mr. Secretary, your predecessor and I and the other members of this board went to 11:30 one night, which really exhausted people. So.
Well, I'm good with that. I don't have to, but I know you have to leave.
Yeah. So with that, Madam Director, I do not see the superintendent here. I don't know if he's excused. He did talk about being away.
Mr. Chairman, yes, it's my understanding that he is away at a family event.
Well, very good. So for the record, let me say that we have a quorum and that the superintendent is excused. And with that, let me turn the floor over to you.
Thank you, Mr. Chairman. The first item on the State Loan and Investment Board agenda for today is approval of the minutes under letter A. We have 3 sets of meeting minutes that require approval. The August 4th, 2022 State Loan and Investment Board meeting, the September 6th, 2022 State Loan and Investment Board special meeting, and the September 14th, 2022 State Loan and Investment Board special meeting. You may recall, Mr. Chairman, that the special meeting had to do with the charter schools. So I will leave it to you to decide if you'd like to take them individually or collectively.
Thank you, Madam Director. What is the pleasure of the board? I do believe that it may make sense to consider the charter school minutes separately in a separate motion. However, I leave that to the good advice of this board.
Mr. Chairman, I would move approval of the August 4th, 2022 Slib meeting minutes.
That motion's been made. Is there a second? Second. Made and seconded. Is there any discussion? Any discussion? All in favor signify by saying aye.
Aye.
Motion carries. And entertain a motion on the September 6th State Loan and Investment Board special meeting.
Mr. Chairman, are both September 6th and 14th, those are both the charter schools?
That is correct.
May I group those together?
Absolutely.
I would move approval of the September 6th and 14th, 2022 Slib meetings.
Second.
Been moved and seconded. Any discussion? Hearing none. All in favor signify by saying aye.
Aye.
Motion carries. Thank you, Madam Director.
Mr. Chairman, we have provided the board with the usual reports behind tab B. We do not have anything else to add at this point, but we would stand for any questions the board might have.
Are there questions for the matters behind tab B? Hearing none, please proceed.
Mr. Chairman, we have provided the materials for this meeting in advance and have briefed each of the board members individually. At this time, I am prepared to propose a consent list if the board would so desire.
That would be fine. Thank you, Madam Director.
Mr. Chairman, the following items for the State Loan and Investment Board agenda for October 6, 2022 appear to be amenable for treatment on a consent list. That would be F1 and G1.
Members of the board, you've heard the director's recommendation for F1 and G1. What is your pleasure?
Mr. Chairman, I would move a consent list consisting of F1 and G1.
That motion's been made for a consent list. It's been seconded by the secretary. All in favor signify by saying aye.
Aye.
We have a consent list of F1 and G1 before us. I would entertain a motion to accept the director's recommendation on F1 and G1.
So moved, Mr. Chairman.
Moved by the auditor. Is there a second?
Second.
Been seconded by the secretary. All in favor signify by saying aye.
Aye.
Those matters pass. Thank you. To you, Madam Director.
Mr. Chairman, next on the agenda are the C matters. These are policy matters. We have a number of emergency rules that need to be re-upped and some regular rulemaking. I would yield the floor at this point to Patrick Miller from the Attorney General's office. He will go through C1, C2, C3, and C4. They are all dealing with rules, some of which deal with the ARPA programs and one that deals with the fees for the charter schools. So with that, I would yield to Mr. Miller.
Mr. Miller, good to see you today. Thank you. The floor is yours.
Thank you, Mr. Chairman. The C1 deals with Chapter 40, the Health and Human Services Capital Construction ARPA Grants Program. The office received a single comment on these rules and is recommending no changes based on that comment. The office is, however, recommending one addition to the rules that was not contained in the initial draft, and that is the addition of a summary rejection provision noted in red on the drafts provided. That provision would simply allow the office to remove applications that are clearly ineligible under the appropriation or under ARPA. If there's any doubt or any question, that would come before the board. So this is a provision to be exercised sparingly. Chapter 41 is the water and sewer ARPA grants. There were no comments received on these rules, and the office does not recommend any changes. Chapter 42 is the local government projects ARPA grants program. There was one comment received, and the office does not recommend any changes based on that comment. And then Chapter 14 are fees for administrative services. This was the charter school monitoring fees. There were no comments received, and the office does not recommend any changes. The office is recommending that the board reauthorize the emergency rules and authorize for final promulgation the regular rules. Because the regular rules will likely not be promulgated before the emergency rules expire, we think it's wise to also approve emergency rules at this time. The emergency and regular rules are identical.
Thank you, Mr. Miller. I think we'll probably take those one at a time. On the Chapter 40 rules, what is the pleasure of the board? Thank you, Mr. Treasurer. The Treasurer has moved due pass for the Chapter 40 rules. Is there a second?
Second.
It's been seconded by the auditor. Is there any discussion? Hearing none. All in favor signify by saying aye.
Aye.
Thank you. That motion carries. Now before us are the authorizing the regular rulemaking process for Chapter 41, Water and Sewer ARPA grants. What's the pleasure of the board?
I'd move the director's rec, Mr. Chairman.
The auditor has moved the director's recommendation. Is there a second?
Second.
It's been seconded by the secretary. Any discussion?
Is this the one that needs amended?
Mr. Chairman, Chapter 40 was the one that needed amended. I took your motion to be the director's recommendation, which included the amendments.
Yeah.
So I believe we've covered that.
Yeah. Any further discussion? So just because I lost track on that, we have a motion from the auditor, a second from the secretary. Discussion. All in favor signify by saying aye.
Aye.
That motion carries. Thank you. Now in front of us is Chapter 42, Local Government Project ARPA Grants. What's the pleasure of the board?
Mr. Chairman, move the director's recommendation.
Thank you, Madam Auditor. That motion has been made. Is there support for the motion?
Second.
It's been seconded by the secretary. Any discussion? Any discussion? All in favor signify by saying aye.
Aye.
That motion carries. Thank you very much. Now we have matter C4. This is an adoption of emergency rules for State Loan and Investment Board, Chapter 14. What's the pleasure of the board on this matter?
Mr. Chairman, I'd move the director's recommendation.
Thank you, Madam Auditor. That motion has been made. Is there a second for that motion?
Second.
It's been seconded by the secretary. Is there any discussion?
Yeah, Mr. Chairman, what's the definition for vacant land in in the emergency rules? Or is there?
Mr. Treasurer, this has to do not with vacant land.
Okay.
Yes,
This
Mr.
is
Chairman,
regular-
Mr. Treasurer, this is the charter school monitoring fees.
Oh, the charter school, okay. all
I
right.
believe item C4 on the, or one of the policy matters on the land commissioner's agenda is the rules you're
That
referring
is
to.
correct.
All right,
So this is for charter schools,
okay, Mr. Chairman.
and these are emergency rules.
Yeah. Good to go.
Further discussion? Hearing none, all in favor signify by saying aye.
Aye.
Motion carries. Thank you.
Mr. Chairman, I believe Representative Stith has been trying to get our attention,
Oh.
waving at us here.
Oh, Representative, I'm sorry, I don't have my computer quite lined up yet, so I forget to look at the screen. Thank you.
No, Mr. Chairman, I just had a comment on item C3. I think the office was wise to reject the proposed amendment that would have given a higher priority to affordable housing. I think it's appropriate to keep the rule as it was. So thank you for approving it as is. I think if the legislature had wanted to make affordable housing the highest priority under that category, it would have and could have said so. So I thank you for, I want to thank the office for doing what it did. And on that topic, as far as administering that program, I know these applications have been on a very fast track. We have some municipalities where there will be a turnover in the office of mayor for those municipalities in January. And to me, it would make sense so that the incoming administration supports the applications, that the application deadline, if possible, for that $50 million that's set aside for municipalities, that the application deadline be after January the 3rd, so that you wouldn't have a situation where the outgoing mayor proposes a project that the incoming mayor does not support, for example. So that's just a comment on that. Thank you.
Representative, thank you for your comment, and apologies again for not noticing you. Mr. Miller, do you want to respond to that?
Thank you, Mr. Chairman. Representative Stith, I do believe that is the office's plan at the time being. Those rules, we are not expecting to begin accepting applications until after the water and sewer grants have been awarded, so that applicants that don't receive those grants but would qualify under the local government rules would be able to submit their application again for the local government program. And that would place the application deadline sometime in mid-January would be my guess, or that's certainly within the realm of the office's powers.
Thank you.
Thank you.
Mr. Chairman, if I could respond to just quickly on the deadline for the applications. As Mr. Miller indicated, that was the plan, was to delay the local government applications until after the water wastewater awards had been made, so that folks could take advantage of the other pot of money, if you will, in the event that they were also eligible. Because the sort of the last date we have set aside, I guess, for a Slib meeting related to water, wastewater, HHS, if needed, is November 9th. So we could certainly delay the program for the local governments later than that, and open up applications either in, mid to late November or December, or however the board would wish to proceed. Our intention was to get the funds out as quickly as possible, and Representative Stitt certainly makes a valid point. So we would set that application period at the board's pleasure.
Thank you. Thank you, Representative. I think well spoken, so very good. So that brings us to matter C5.
Mr. Chairman, matter C5 is informational, but I did want to move down to C6, and C5 and 6 are a little bit related. C6 is to consider the annual authorization and adoption of the Drinking Water State Revolving Fund Intended Use Plan and Comprehensive Priority List. In order to receive federal fiscal year 2023 Drinking Water State Revolving Fund Loan Program Capitalization the grant from EPA, the board must authorize and adopt the fiscal year 2023 drinking water SRF intended use plan for the use of the funds. The IUP, which is attached to the board matter, describes how the state plans to use these funds to meet the Safe Drinking Water Act objectives and to further public health. DEQ, the Water Development Office, and OSLI jointly developed the proposed 2023 IUP, and then DEQ published in the newspaper on April 10th, 2022. I believe it appeared in the Casper Star. OSLI, DEQ, and Water Development afterwards held a public meeting in Cheyenne on May 12th to provide the public an opportunity to comment on the IUP and the comprehensive priority list for 2023. No comments were received. On August 17th, the Select Water Committee reviewed and accepted the 2023 Drinking Water SRF IUP as required under Wyoming Statute 16-1303. The statute also vests the board with responsibility of giving the final authorization and adoption of the annual IEP. If the board provides the final authorization today, OSLI will submit this document to EPA upon its next capitalization grant application. So we are recommending that the board provide final authorization and adopt the 2023 Drinking Water SRF intended use plan and the final comprehensive priority listing of eligible projects for the time period October 6, 2022 through June 30th, 2023. I have Beth Blackwell with me, our grants and loans manager, to answer any questions, and she can also talk about why C5 does not require board authorization. So, Ms. Blackwell, I would yield to you.
Thank you, Ms. Blackwell. Yeah, I didn't know if you wanted to talk a little bit about C5. Doesn't matter to me if you don't, but I understand that we're action items on C6. So.
I'm good not talking if nobody has questions.
Are there questions? Very good. Got off easy. So, questions on drinking water state revolving fund specifically? Hearing none. What's the pleasure of the board?
Mr. Chairman, I would move that we give final authorization and adopt the 2023 Drinking Water State Revolving Fund IUP and the final comprehensive priority listing of eligible projects for the time period October 6, 2022 through June 30th, 2023.
Thank you, Madam Auditor, for that motion. Is there support for the motion?
Second.
It's been seconded by the secretary. Is there any discussion? Hearing none, all in favor signify by saying aye.
Aye.
That motion carries. Madam Director, back to you. Boy, Beth, you got off easy.
Oh, wait, there's more. Mr. Chairman, that brings us to C7, and while that is an information-only agenda item and requires no action from the board, the agency, OSLI, we are seeking feedback from the board to share with the Joint Appropriations Committee. They've invited us to come and testify on October 26th. You may recall that one of JAC's priorities is to look at all the state loan programs. They're trying to understand the programs, the demand, what would be the appropriate funding amount for those programs, and whether certain loan programs could actually, whether they should actually continue. They specifically asked OSLI to look at the farm loan program and to look at the capital construction loan program. We analyzed, I think it was 11 years of information related to demand and utilization of those programs. We've come up with some recommendations that appear within the Board Matter C7, particularly in the table there. We have met with each of you individually and discussed our recommendations. We were just wanting to make sure if the board had any collective comments for us to take back to JAC, that there was an opportunity for us to gather those and provide those. I do know that we are under tight time constraints today, but to the extent, Mr. Chairman, that there are comments that you would like us to take back to JAC, we would be happy to receive those.
Sure. Thank you, Madam Director. Mr. Treasurer, I think you and I have had a lot of experience both at administering and perhaps also taking advantage of some of these. The ag loan program from time to time comes up because it's not utilized, and it's not utilized because the interest rate is high, but it always has existed as kind of a circuit breaker. You know, and I can remember back in the late 1980s when interest rates were 18%, 19%, having this program in place was extremely valuable. I do think that there may be some ways that that money isn't sidelined so it can still be invested, but, you know, because, you know, those interest rates sort of change over time. The beginning ag loan program, we've seen a lot of, and I'm sure we'll see more of that, but I didn't know your thoughts on that. You know, my view is if it ain't broke, don't fix it.
Yeah, I kind of thought if we, if we were going to take some off the table, it might be reasonable, but I think that we should have a trigger and maybe locked into the Fed's fund rate or some public index is mortgages or something, that when they got to a certain level that, you know, that basically the board could ask the state treasurer to, I guess, infuse $100 million cash or something like that. So something like that, I think, would work. Not so you'd have to go back to the legislative process, but something that would say, you know, when that trigger got hit, then OSLI would come to us and ask the state treasurer to make that capital change.
Sure, and as a practical matter, cash is not cash in the portfolio.
That's
It's
right.
in,
Yeah,
it's
90-day
in,
treasuries.
yeah, it's 90-day treasuries, and so I think I'm wondering if there's a way, you know, to consider maybe an allocation there that because you know you're not going to see that program overnight showing up, and it's going to take a certain amount of time to process. So if there was a way that we could invest it perhaps a little bit more aggressively, but still be able, you know, so it's not locked up for the interim on that.
Well, I think that as we're going through this process that you guys will be more aware of, I think after Patrick gives us some more information on what we're doing is I think there'll be a spot in there where we might be able to put some of this cash in the ladder strategy, which would give us a little higher return. And that rolls off roughly every quarter. So, you know, if we had something that said that the Slib will, you know, ask the treasurer to get those funds in there with, you know, on the next quarterly rebalance, then that doesn't interfere with our
Yeah.
duties and investment
Yeah.
hardly at all.
And Mr. Secretary, you know, what is interesting about this, in my time, conversation about the farm loan program has gone from it's not used, so we should lower the interest rate and compete with private banking, to, you know, it's not getting used, so let's take it away. And that's why I asked the good treasurer, because I think we've both been in ag for a very long time, and conditions aren't always perfect. So if it is a circuit breaker, which is, I think, the way the program was first meant to be, I think it can protect our family ranches in adverse times. So,
Yeah, and those adverse times might be right around the corner, so.
well, I think so too. Now, the other thing that I think bears some thinking about was Ms. Blackwell's notion about loan guarantees, which also could provide a certain amount of, I guess, runway before a person had to jump into this. So I think there's some things that we can look there. I did also want to, you know, you and I both shared the same concerns about the capital construction loan program, and from the point of view of performance, you know, the interest rate on this is, I think, 2%, reaches 2% after 25 years and starts out at virtually nothing. So it's a wonderful program. It does, and I see it's getting used, but it still has quite a bit of room. The joint powers loans don't get used because the interest rate's high and the diligence on them is high. The student dormitory, you know, both the capital construction and the student dormitory came about because of legislative desires to make things easier for certain projects. I just not sure I like that, being honest. And I think, Mr. Treasurer, you've also expressed some of those same concerns.
Yeah, that's true. So I think some of them can be cut down and more money put into more profitable areas, so.
I think when we had our conversation, Ms. Blackwell and the director suggested maybe rolling, and maybe tell me if I'm misspeaking, but I think rolling all of those programs together and recrafting the capital construction program to some degree is maybe a way to do that. Madam Auditor, I don't know if you have any thoughts on that.
Mr. Chairman, I do like that idea because then you share amongst them too the risk of everybody trying to hit the same thing at the same time. I'm curious, and I'm curious what the utilization on the ag program has been over time. I mean, have we ever come close to that limit even when things were very, very bad? Is any reduction appropriate, or what I think I heard you say is maybe no reduction is appropriate? That's sort of my curiosity is, what is the total allotment done over the last 30 years, and how close have we come to it?
Mr. Chairman, Madam Auditor, I was not here during that time period, but from previous staff members who have retired, my understanding is the full allotment was utilized, and in fact, there had to be a hold put on new applications because the interest in the program was so high that staff at that time could not keep up with the applications because the board, correct me if I'm wrong, Beth, but I believe the board met monthly at that time. So in the 80s, late 80s, it was fully utilized.
Mr. Chairman, any clue what the allotment was at that time? I'm assuming it probably wasn't 275 million.
I do believe it was relatively high. I'm not exactly sure, but it very well could have been over 200 million.
Thank you, Mr. Chairman. And Mr. Chairman, what I think I also heard is that the OSLI's comment or recommendation of 0 for dormitory loans and similar things is probably appropriate, and I would agree with that.
Thank you, Madam Auditor. Mr. Secretary.
Thank you, Mr. Chairman. I appreciate the Treasurer's comments about maybe having a trigger that we could put some more into that agricultural. If I do see the interest rates going that direction, and agriculture is one of our basic things in this state, and we do need to maintain that. So I could see if we could somehow figure out where we could have a trigger if the interest rates hit a certain point that we could put money back into that. I do agree with the recommendation, though, joint powers and student dorms, that we take those down to 0. Student dorm loans, those could be rolled into capital construction if they do come up. So I would agree with taking both those programs down to nothing, but somehow figure out what kind of trigger we can use for those farm loans.
Thank you, Mr. Secretary. Further comments? Madam Director, are you looking for anything more? I think some of us might have some offline comments that can be helpful with that, but I don't know if there's more that the board wants to discuss on this matter. Ms. Sewell, good to see you. Thank you. I can vouch for the fact that program was incredibly important. You had an entire banking sector go down at that time. The PCA sector dropped and people lost their loans and they couldn't refinance. And I can attest to several ranches and families that were able to keep their operations alive during that time. And I do remember there was a queue and there were a lot of rejections. So.
if we ever get back to that place, can I have some more staff, please, sir?
Well, to that point, Ms. Blackwell, it does seem to me that, looking at a way to craft a loan guarantee program where the underwriting is sort of first done by an institution, and we may be able to work with the bankers to sort of see if there's a way to do that. And there may be other institutions as well, but that might be a great way to sort of take the load off your mind. I know, Mr. Treasurer, when we talked about like Atlas Carbon and some of that, sort of looking at a loan guarantee servicing model that was not necessarily in-house made some sense. Well, thank you. Thank you very much.
Thank you,
Madam
Mr.
Director.
Chairman. And if board members have any other comments they wish to share, we will be putting our materials together for joint appropriations tomorrow and Monday, so hurry.
All right, thank you.
Thank you.
I hope that's been helpful.
Yep, that's great. Thank you, Mr. Chairman.
Mr. Chairman, just a
Mr. Secretary.
quick question. When we got to number 5, we jumped over to 6. I don't think we took action on 5, did we? We jumped
Mr.
over
Chairman,
right
oh,
to-
Mr. Chairman, C5 is an information-only matter, and that's one of the nuances. The Clean Water IUP does not need board approval. That's just the way that program is set up, but
Okay.
Yeah, I'm sorry, I probably misled. I was trying to give Ms. Blackwell the opportunity to sort of describe the program, but it is information only. So thank you, Mr. Secretary.
okay, Mr. Chairman, that brings us to the D matters, and I would yield the floor to the Treasurer's Office.
Mr. Treasurer. Can you make sure your mic is on, sir? Okay.
Get over here and hope that my book is in order. I got the right book? No, I don't have the right book. B3 Angela Gordon, okay, all right. Mr. Chairman, we're going to start with D3, Angela Gordon. And I will turn this over to our CIO and his trusty sidekick.
Mr. Chairman, Mr. Treasurer, thank you. My name is Patrick Fleming. I'm CIO for the Treasurer's Office. Today, as you know, we've met with all of you individually to go into much more detail on the managers, but we do have the managers in person here today to tell you a little bit about their fund. Just as a intro on how we're looking at these managers fitting into the fund and the purpose. As you know, last May, we looked to change some of the structure and reduce our exposure to core fixed income and increase our exposure to certain private markets. This would be one of the private credit markets that we will be implementing over the next 4 years. As far as the big picture, we have been very conservative in our investment allocations. We feel that valuations were extremely high over the last few years, and as the Federal Reserve would increase interest rates, that going from 0 to now what is forecasted to go up to 4.5%, there would be many issues in the markets that would come to fruition as people were used to very low rates, and some certain things could potentially happen. So with that conservative nature, when we are looking at these markets, Caleb will talk to you a little bit more about it, but we were looking for a very conservative entry into these markets to make sure that the managers that we select would not have an extreme amount of leverage or have problems in a difficult period that we think is, and the market believes is probable over the next few months to who knows how long it can be to when the Fed goes. But over the next year anyway, we see that there could be some turbulence if you believe the Federal Reserve will hold rates at a very high level. So with that, I'm going to pass it over to Caleb, and also Josh Keevan will comment on RVK's view on the fund, and also Ken Lay, I believe, is on to talk about the IFC's view, and then we'll have the managers speak to introduce themselves and tell you about what they're about. So with that, I'm going to pass it over to Caleb.
Excellent. Thank you, Patrick. And good morning, Mr. Chairman and members of the board. My name is Caleb Simpson, and I'm an investment officer with the Wyoming State Treasurer's Office. Today, I'm putting forth 2 private credit managers and their respective strategies for your approval. The 2 funds represent the culmination of many months' work to identify private credit strategies that will, A, deliver the highest risk-adjusted returns in direct lending and specialty finance, B, produce a high distributable yield, and C, protect capital in the case of an economic downturn. The first fund that I will be recommending today is Angelo Gordon's Direct Lending Evergreen Fund. First, I'll start off by providing a high-level summary of some of the fund terms and what we can expect from return outcomes. And then I'll walk through some of the finer points as to why I believe Angelo Gordon represents the best in class in lower middle market direct lending. So first of all, I'm recommending $100 million to the fund in commitments. The targeted return for the fund is going to be 10 to 13% net on a levered basis. The fund's going to target anywhere from 1 to 1.5 turns of leverage. The targeted distributions will be distributed, the income will be distributed quarterly, and they're targeting 6 to 8% on an annualized basis. As you know, this is part of our private credit build-out. This will represent Fund 2. If the board recalls, you all approved BlackRock and their Global Credit Opportunities 2 fund in April of this year. The fund is an evergreen vehicle, and the investment period is a rolling 3-year term, with the first investment period ending on December 31st of 2025. The first withdrawal date would be December 31st of 2025, with 180 days notice. And with that, Angelo Gordon and team really represents best-in-class exposure to senior secured direct lending to lower middle market companies in the U.S. What do I mean by lower middle market companies? That's companies with $5 to $50 million in EBITDA. Angelo Gordon was chosen due to the highly defensive structure of the loans that they make. Middle market direct lending volumes have grown exponentially over the last few years, with lenders lending at very high multiples, utilizing unitranche loans, and offering few covenants. In this period of economic uncertainty, it is paramount that WSTO only invests in the highest quality lenders, as private credit is an asymmetric asset class in which we can expect to receive a 10 to 12% net levered return while facing up to 100% in capital losses. AG only lends to private equity sponsor-backed companies, with 98% of their loans being senior secured. Additionally, Angelo Gordon has been the administrative agent or co-lead on 96% of all deals that they've done historically. The fund is targeting companies with targeting deals with loan to values ranging from 40 to 55%, which is much more attractive and much more prudent relative to peers in the space. And the fund is going to offer a very highly diversified basket of companies and loans, over 100 names, with an emphasis on healthcare lending. This healthcare bias was strategically sought out due to the market uncertainty and the inelasticity of demand in this sector. The Evergreen vehicle will be the first Evergreen offering by AG. However, AG has been investing in traditional closed-end funds since the founding of Twin Brook Capital Partners, owned by Angelo Gordon in 2014. Risk-adjusted returns have been exceptional, ranging with a 10.7% net IRR and a 1.24 net multiple throughout the fund's history. In addition, the funds have employed low levels of leverage relative to competitors and low deal leverage levels at approximately 4.4 times. The senior team has an unparalleled tenure of investing together in the middle market dating back to 2001, which results in AG often being the first call and preferred partner of many private equity sponsors. The team has access to AG's deep pool of resources, yet remains nimble with $14 billion approximately of AUM. And with that, I will turn it over to Mr. Keevan.
Good morning, Mr. Chairman, members of the board. Josh Keevan. I'm a senior consultant with RVK. So I believe I can make my comments relevant for both managers that you're going to hear from today, because that's ultimately what we're here to do today, is to recommend 2 new managers for your investment program. But I want to take a step back a little bit. You've heard a lot about the details from Mr. Simpson. You'll hear from both managers. I want to step back and talk a little bit more high level about the overall strategy and where this fits in your portfolio. You may recall that you approved a new target allocation, a strategic part of your asset mix to private credit in the latest asset allocation study. And as Mr. Fleming noted, these are private markets, so it takes some time to build out your allocation to it. Now, private credit is going to be a little bit of a hybrid, unlike private equity, where all of the funds are finite life, closed-end funds. Private credit, we actually anticipate having both open-end, sort of ongoing evergreen funds, like some of your core real estate funds, as well as some more specialized finite life, closed-end funds. The 2 funds that are before you today, we actually see as they're both evergreen, so ongoing evergreen. There's no final term. We see these as 2 really sort of bedrock foundational components to your private credit program. Within private credit, we break the universe into, generally speaking, this is an oversimplification, but big picture, sort of 3 major buckets. One is corporate direct lending to middle market, smaller companies, as described by Mr. Simpson. The second is asset-backed and specialty finance. And the third is the one that you started with the BlackRock Fund, which is more special situations. And that we would also lump distressed in there, so more to distressed corporate debt investing. You're probably more familiar with traditional fixed income markets, where you've got different types of borrowers. You've got government, you've got corporate, and then you've got this category of asset-backed securities. Asset-backed securities are largely pools of consumer debt, things like home equity loans, auto loans, things of that nature, that get structured and securitized in a way that investors can sort of pick and choose, more conservative or more aggressive tranches of that type of debt. That's the public markets. And what I would submit to you is that within private markets, those same things exist. These are just privately negotiated transactions, but the underlying instruments are not all that different than what you already own in public markets. And we do believe that by selecting really good managers with really good credit underwriting skills that understand and have good access to deal flow, you can earn a pretty significant yield premium, and in a lot of ways actually improve the protections by, if you're structuring these deals appropriately. So the last thing I will tell you is, so Angelo Gordon represents the first category I mentioned, corporate direct lending. The second manager you'll hear from, Atalaya, represents private asset-backed securities. And both of these are RVK best ideas. So as a firm, we've been planning for some time to help clients increase their allocations to private credit. We see it as a relatively high risk-adjusted return. So we have kicked a lot of tires, turned over a lot of stones over the past 4 to 5 years. These are 2 of our best ideas. We have several clients invested with both firms, And we see these as very, very important sort of foundational bedrock pieces to your growing private credit portfolio. So I will stop there, Mr. Chairman. Happy to answer any questions that the board has.
Thank you, Josh. Do we want to hear from Mr. Lay?
Yes, Mr. Chairman.
Ken, it's good to, you have the floor. It's good to, well, it's good to see you.
Well,
Are
thank
you
you.
in
Mr.
Glen
Chairman.
Rock today?
Pardon me?
Doesn't look like you're in Glen Rock today.
I am not. I'm back in the swamp, if I can put it that way. Temporarily, fortunately. No, Mr. Chairman and members of the board, I appreciate being asked to weigh in on this. Yeah, I think Josh and Caleb have done a good job, describing the considerations that the IFC also took into account. As you know, we take a great deal of comfort from the due diligence that Caleb and his colleagues do, as well as what Josh described as the importance as the views of RVK on these particular managers. I think we had a chance to look in detail at the information that they will have provided to you. And I think the committee was unanimous and have full confidence in these two selections. I think it was particularly interesting to hear the history of these firms, their background as lenders in these sectors. And I think we share the view that Josh and Patrick and others have indicated, to the effect that these are going to be important bedrock investments in this particular asset allocation that we're considering. So bottom line, the IFC is fully supportive of these two recommendations, Atalaya and AG. And it was actually very good to see that we've been able to identify these and of course to get capacity with them. I also think we took into account the fact that the evergreen structure is obviously very good to see in this area, in these particular asset classes. So I'll stop there and thank you.
Thank you. And then you have the manager here. One of the things, and Caleb, thank you very much for providing the charts you did. I guess one of the things I was concerned about was just having a notion of where our exposures in these funds would be. Where the tranches would lie? Would they be, retail sector, tech sector, those kinds of things, just to sort of have an overall sense of where our exposures were, kind of not necessarily specific to the managers. I'm sure they're broadly diversified, but just with a sense to what our portfolio might be doing as well.
Mr. Chairman, would you like me to comment on that further?
If you wouldn't mind, and I don't think we have to spend a lot of time, but that just wanted to have a sense of where that was.
Absolutely. And so thank you, Mr. Chairman. Specifically with regards to Angelo Gordon and their Twin Brook platform, what you can expect is sector exposures, 12 to 14 sector exposures per fund. So if you look back historically, dating to their first closed-end vehicle in 2014, going through Fund 5, which they're in the midst of capital raising in parallel with this evergreen vehicle. The predominant exposure historically you've seen has been to healthcare lending, right? And so that historically has averaged about 35%. And that's predominantly practice managers. So if that's going to be, buyouts of small regional dental practices, et cetera. So that's going to be by and far the largest concentration by sector. And then other areas they are not going to lend to. You're not going to see lending to, and this is something I touched upon and stressed with the IFC is, retails, restaurants, traditional travel industries. Those are sectors they're going to avoid. In addition, if you look back historically, metals, mining, as well as energy, and not due to ESG concerns, due to risk-adjusted returns relative to other asset classes and other loans that they can put out in the healthcare space, tech space, et cetera.
Thank you, Mr. Simpson. Mr. Fleming, do you want to introduce the manager?
Yes, Mr. Chairman. And before do the introduction, I would just like to comment from the IFC that it was a unanimous vote for the IFC that they all approved and on both of the managers, just to make sure. You had mentioned you wanted to know the vote with that one. So Caleb, are both managers here? Or are
Yes,
you going
they
to?
are. Yep.
Okay. So with Angela Gordon, Trevor Clark, who is the founder of Angela Gordon and the main person in charge, and also I believe Annie Knapp from their business development and investor relationship department will comment to you this morning.
Thanks very much. Well, welcome. It's good to have you here. And it's wonderful that Mr. Treasurer is able to chair the IFC to kind of go through and do the preliminary. So really very, very much appreciate their diligence, and we respect that and that of RVK. So it's good to have you here. Yep. And if you could just identify yourself for
the process that your team and RBK concluded as part of this review, amazingly detailed. So I would commend the people on the other side of the process. We go through these types of discussions with many different groups, not always this level of detail. So very, very serious and thoughtful approach to it.
Thank you very much. And if you just identify yourself.
Of course.
Yeah.
I'm Trevor Clark. I'm the head of Angela Gordon's direct lending business, known as Twinbrook Capital Partners.
And good morning. My name is Andy Knapp. I'm a managing director with the Client Partnership Group at Angela Gordon. My role is to support our relationships with institutional investors in the central United States. Mr. Chairman, members of the board, thank you for having us here today. Thank you for the opportunity to introduce ourselves and develop a potential partnership with your group and with the state of Wyoming. What I thought I'd do today is just open with a very brief introduction on Angela Gordon as a business, and then pass it to Trevor to walk you through a bit more on Twinbrook and the strategy following the very nice tee-up from Caleb. If I may flip you to page 3 of the presentation that we've prepared, this gives a bit of a high-level backdrop on Angela Gordon as a business. Just a few points that I would call out here. Angela Gordon is a leading alternative investment firm with a focus on credit and real estate strategies. We've been managing money for institutional investors for more than 30 years, since our founding in 1988. And today we have more than $50 billion in assets under management. Roughly 2/3 of that asset base resides in credit-related strategies. 1/3 we would consider to be in real estate. And our credit platform consists of strategies that invest across both public and private market opportunities. In addition, we have flexibility across the platform to invest from performing situations, such as what we're doing with Trevor's business, to more distressed or special situations. The last thing I would say is that our business is really predicated on an ability to deliver consistent absolute returns for investors through cycles. That's what we've demonstrated over the past 30 years. It's why we've been able to establish the pedigree that we have today, and it's why we have significant relationships with institutional investors in the United States. With that, I'll pass to Trevor to dig in a bit on Twinbrook.
Excellent. Thanks, Andy. Mr. Chairman, members of the board, pleasure again to have this chance to give you a quick update. For your background, this is my 28th year in the direct lending space, so I've been operating in this field for a long time. More importantly, if you go to page 4, that gives you the beginnings of the backdrop of what is Twinbrook Capital Partners, the direct lending business at Angela Gordon. You'll see a reference to 2014. it's important to understand that's when I brought the senior members of my team over. We're going to be speaking a lot about our strategy, the consistency of what we've done. The first 7 years of my career in the direct lending space were at commercial banks and private financial services institutions. Took that experience and wrote a business plan to found my first direct lending business back in 2001. Relevant for today's discussion because the strategy we're going to be speaking to, we've been executing consistently since 2001. So while the data you're seeing is from 2014, as we discussed with Caleb and the team from RVK, there's a much longer track record that also backs this up. Also very important to note, and Caleb and Josh made excellent points about this. When you think about the world of private credit, lots of different ways that you can approach this space. Ours was very specifically focused on capital preservation, the ability to produce a return regardless of market conditions. That's what drives our target marketplace, and it drives our strategy around that. You've seen here on this page a quick highlight of some of those pieces. We'll get into more detail. You'll see the awards we've won. That really isn't the driving force between how we view our business. It really comes down to the stability of what we've created. The next couple pages, I'm actually not going to spend time in the interest of time, only because it highlights the growth of our platform and then the team, which we'll get to later. If we can go to page 7, this really underpins the strategy of that stability. For us, it was very clear. In the business of lending, where you're bringing a commodity, a product of cash, you need to bring something that's differentiated. For us, it was very clearly focused on a couple of key areas. Number one, the type of borrower. We look at lower middle market companies because at that size of borrower, the relationship between the borrower and lender has a much more partnership focused. As I'm sure you've seen over time, when you move up in size of borrower, the relationship between borrower and lender becomes much more transactional. You get devalued. You get asked 2 questions. How much debt are you going to give me, and what's the cost of it? When you move into the lower middle market, our relevance, our history, our support mean a great deal more, which thereby allows you to have returns be much more stable. What you'll also see on this page is this. Because we target lower middle market companies, the average small company doesn't have the same stability as the average large company. It means we need to bring other forms of stabilization to this process. In a typical year, we will look at 1,500 unique companies. We'll typically select 3% of those to actually pursue. We will spend 2 to 3 months of due diligence before finally closing. And then as Caleb and Josh pointed out, we'll bring all matters of additional levels of protection. Every single one of these loans has a long-term history, the companies, of profitable operations with very little period instability. As we pointed out in the industries, we're not targeting industries from an ESG standpoint. We're not targeting industries that show historical volatility. When you look at healthcare, you look at business services, you look at manufacturing, distribution, that's why we're targeting those industries. They have inherent stability associated with them. The role we play, we demand to be a leader in these credit facilities. We know that puts us in the front end of driving the interaction with the borrower. It also allows us to have a greater impact when things don't go according to plan. Key element to this, selection of a really good company is important. Underwriting that company is important. I can guarantee you after doing this specific strategy for 21 years, if our strategy's return was dependent on always being right and not having protections below us, it would not work. So having the financial covenant protections, not putting too much debt in these companies, being that first dollar in the capital structure, having an experienced team behind you, those elements all work in concert to produce that stable, rock-solid return. And for 21 years, we have never missed a targeted return with that strategy. One last piece I'd like to highlight. When you look at, well, I guess 2 pieces. On page 9, this shows you some historical statistics. Again, these are just for the last 8 years. What I would note at the top, it's giving you some summary statistics about the amount of capital we've deployed and the low loss rates. I think it's equally important to highlight when you're looking to us, you're not only looking to the end amount of a return we can produce, but what's the stability to that return we can produce while you're investing alongside us. And so I point to that bottom chart where you see the BB index having a significant amount of volatility, in that green line showing you money flows that kind of move things up and down versus our line, the blue line, with a significant level of stability. Every single one of our loans gets held at par, less its unamortized upfront fee, which is typically 2 points, unless there's a credit event. Significant stability in this. And as we're going into the period of time, I think we can all agree over the next several years where there will be more volatility, you should take great comfort in understanding that you're not going to be seeing wild swings in the performance coming out of your return. Last piece I want to hit on page 10. This gets the creation of the return that's taking place. 2/3 of the return you will receive from our fund just comes from the interest we are receiving from our borrowers. Again, highlighting the stability of that return. Those two other rows, the origination and other upfront fee versus the other fee in return, are very interesting components. The origination and other upfront fee, as you would expect, that's part of the economics we receive for originating, closing, and managing these credit facilities. The other fee in return comes in when there's our amendments, restructurings, default interest. As you would expect, that second and third row come into play much differently depending on the economic positions. From 2010 to 2019, the second row developed the majority of that remaining return. In periods of time like 2008, 2009, and obviously what we're starting to see today, that third row starts to pick up. So where other direct lending managers see a return fall off during periods of economic disruption, we don't have that same impact. I'll stop there and see if there's any additional questions.
Thank you, Madam Auditor.
Mr. Chairman, a couple. Which office is Twin Brook based in, or is it across your?
So we are Chicago-based.
Okay, and one more question, and this is probably very ignorant, but I'm committed to asking ignorant
Please
questions.
do.
Do businesses come to you, or do you go to businesses? And as a business, what's in it for me?
Sure. That's a fantastic question. You start with this. Because we're focusing on lower middle market companies, and again, I started my career in the commercial banking world. Up until 2000, to do this type of lending, it was really all done through commercial banks. When the regulatory apparatus around the commercial banks changed, you saw this business move away into the non-bank sector. Piece number one. Piece number two, from a return stability standpoint, because we're focusing on these lower middle market companies, we demand private equity ownership. So our entrants into these companies are the private equity groups who are looking to do a transaction. Classic example would be an entrepreneur starts a business 15, 20 years ago, grows it to a certain size. The scale of the business gets to a point where he can't continue to grow it, he or she can't grow it. They bring in a private equity partner to help them take it to the next level. The private equity group would come to us and say, hey, we'd like to partner with you to help grow this company. To your second question, why us? Well, this gets to the beauty of the lower middle market. Because if I were upper middle market, as I mentioned before, they only care about how much debt and the cost of that debt. In the lower middle market, the fact that we've been doing this for 21 years, understand that every small company doesn't have super stability in terms of everyday performance, understanding how to work with them through an expansive period of growth. That's why we get selected. Significant amount of focus on partnering with the private equity groups and the management teams, and the fact, and this is the last key piece to this, so many groups come and go in the lending universe. When times are good, they show up. When times are bad, they go away. These lower middle market groups and these private equity owners, they want to know they've got a reliable partner. After doing this for 21 years and never leaving this target market, we stand out as being that reliable partner.
Thank you, Mr. Chairman.
Further questions? Please, Mr. Secretary.
Just one quick question, as I know you've got offices all over everywhere. What percentage of this fund that we'd be getting into is based over, of the business would be done in Europe or in Asia? What percentage of that?
Yes, I apologize. We should have been more clear. That first page that we went through, that Andy had hit on, that was Angelo Gordon, the parent company,
Right.
versus just direct lending business. Direct lending business is headquartered in Chicago. That's where the entire team resides. We only do North American headquartered companies. It gets down to the protections we demand in our documents. We don't want to have to go try to move against our collateral in foreign domicile. So every one of our companies is going to be U.S. headquartered.
Okay, thank you.
Very welcome.
Thank you. Mr. Clark, couple of questions. It's interesting to me, you talk about private equity being kind of the first line there, and that's terrific. What happens if you see a secondary, you get sold off in your private equity partnership and so on and so forth. How does that affect this lending institution?
So again, excellent question, Mr. Chairman. A couple things I'd highlight. When you think about the private equity groups we're working alongside, two things I would note. In terms of the amount of secondary activity that's taking place on their equity base, it's very, very little. These types of companies, they're getting in, they're going to acquire a company, they're going to transform this lower middle market company, typically on it for 3 years, and then move on, sell it, buy another company. When we're going in, part of our decision, and I should highlight this as well, we have closed transactions with 236 different private equity groups. No single private equity group represents more than, at this point, 2% of our overall deal flow. So when you think about the relationship we have with them, we're not beholden to them. We're also very cognizant. We will not go into a transaction where it is the last transaction in a fund for a private equity group unless they have raised their next fund, so we know that they have the capital to support that business.
Okay, and it's just interesting because, that private equity business has a lot of failures.
It does. Well, and as I'm sure you all have heard firsthand as well, if you had private equity managers sitting in front of you, one of the lines you're going to hear from them is, oh, we love the fact that we can get our lenders to do whatever we want them to do, and we can potentially take advantage of that. Again, the beauty of focusing on the lower middle market. There is no form of multiple arbitrage or financial engineering as a private equity group that you can do with a lower middle market company and consistently create a PE return. You have to focus on transforming that company. And that requires our relationship as your lender and you as the owner to be very, very tight. It's also the reason why when you think about this structure, we didn't get into this, we are the revolving lender on 100% of these loans. What that means to you is, if you think about it, you want to fund your payroll. You're not calling a commercial bank, you're calling me. What that also means is when something changes at your company, we as your lender know before your private equity owner, because we're watching those daily draws. So it puts us in a circle of control and influence that's much different. But it's an excellent question because, trust me, have we moved away from certain private equity groups in the last 21 years? And the answer is absolutely, positively yes. Am I looking forward to some of the decisions those private equity groups thought they were making that made sense when everything looked really good from 2010 to 2019, finally coming home to potentially bite them? Because short-term focus, from a relationship standpoint, potentially sometimes means short-term returns.
Yeah.
We'll see what happens.
Yeah. Last question, and do you have I didn't see this in here at all, and it would seem probably not likely, but any exposure to mezzanine, or is that a piece of it?
Zero.
Okay.
Zero. Well, we are first lien, first dollar in capital structure, senior secured. The only thing outside, so 97 to 98% is going to be that first dollar in of the cap stack, typically up to around 44% loan to value. We don't do mezz. What we will do is where we have the opportunity to co-invest in the equity. This isn't an equity kicker. These high quality, highly performing loans, we can do that on a non-promote basis. So 2% of a typical fund will come in that form.
Fantastic. Thanks. Further question, Mr. Treasurer, any comments?
Just that it seems like these guys are a safe place to put Wyoming's money and they get a reasonable return, and that's what we're looking for.
Very good. Further comments? Further comments? Well, thank you both for being here.
It's a pleasure.
And what is the pleasure of the board? Mr. Treasurer.
Yeah, Mr. Chairman, the state treasurer recommends that the board approve, whoops, wrong page. Is on material terms.
We'll get there.
Okay. Okay. Recommend the board select the fund Angela Gordon Direct Lending Evergreen Fund as a state private credit investment manager, conditioned upon the approval of material terms and successful contract negotiations.
Is there support for the motion? It's been, okay. Carl was very gracious, so the auditor has the second. Is there any discussion? Hearing none, all in favor signify by saying aye.
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 That motion carries. Congratulations.
Thank
Thanks.
you very much.
Now we do the tough stuff.
Well, thank you all, Mr. Chairman and board. It's been a pleasure to present today.
Thank you.
Thanks.
And thanks for making the trip. Mr. Treasurer.
Yeah, Mr. Chairman, I think we'll have Matt, we're gonna wait on the other material terms. Okay, all right. D4. Oh, the material terms. Okay, all right. Thank you, Mr. Chairman. D4, this is the matter on the material terms, and Caleb's going to present the material terms.
Yes, sir. Mr. Chairman, Mr. Treasurer, thank you. Just one comment. I was just going over some of the numbers. Mr. Chairman, you asked for the exposure of some of these funds. And one thing just to comment on, the healthcare sector is one of the tilts that we've been actively participating in. So to just kind of give you a little background on the funds that we're focusing on that have that tilt, or we've done the direct investment. So for instance, Hamas that you remember you approved, that was a $50 million fund. The S&P has about a 13% exposure in healthcare. So we have, if you use 13% or what have you, of a $4.5 billion equity portfolio, then there's another $550 million or whatever exposure in healthcare on that side. Our other real estate manager, Clarion, their big exposure is in office healthcare exposure into the medical office buildings. So that is one of the tilts that we've been actively moving to. We just feel that's a much more conservative, longer lasting with the demographics in the U.S. and where we're going. So that's one area that you'll continue, and we're looking at a couple funds right now that also have, that are significantly exposure to healthcare.
Thank you, Mr. Fleming. You understand. I just want to sort of have a sense of what our concentration and exposure to one particular sector would be. And
exactly,
absolutely, you guys are on point. Thanks.
And thank you, Mr. Chairman, Mr. Treasurer. I will now review the summary of material terms for the AG Direct Lending Evergreen Fund. The AG Direct Lending Evergreen Fund is a Delaware limited partnership. And I'll just go at a high level over some of the key material terms. So the first one being the term or commitment period, and the term of the fund, as you know, given it is evergreen, shall continue until dissolved. The fund is open-ended, and therefore there is no commitment period. Regarding distributions and the point we touched upon, they will begin the first quarter after the end of the initial fundraising period. The fund may make quarterly cash distributions to such limited partners who elect to receive, which we will elect to receive said distributions. Regarding redemptions, the investment period means rolling 3-year periods, with the first investment period commencing upon the initial closing date and ending on December 31st, 2025, and each subsequent investment period beginning as of the day following the last day of the preceding investment period. And if you recall, notification requires 180 days notice prior to the end of the investment period for redemption purposes. Regarding limited liability of the state, the general partner acknowledges that the state, like other limited partners, shall not be personally liable for any obligations of the fund and shall have no obligation to make contributions to the fund in excess of their respective capital commitments specified in the fund's books and records, except to the extent required by the LPA or applicable law. Regarding leverage, the fund will have the ability to borrow or leverage its investments on a recourse or non-recourse basis. But the fund advisor, Angela Gordon, expects such borrowing to range from 1 to 1.5 times or 100% to 150% of the fund's net asset value. However, I will highlight that borrowing cannot exceed 250% of the fund's net asset value without the consent of a majority in interest of limited partners. Regarding our Public Records Act, the general partner will enter into a side letter with the investor, the state of Wyoming, in connection with the investor's admission to the fund, acknowledging the investor's obligations under the Wyoming Public Records Act. The general partner also acknowledges that consistent with fiduciary duties applicable to being a registered investment advisor under the Advisors Act, it will act with respect to the fund in a manner that it believes to be in good faith in the best interests of the fund. Regarding most favored nations, the general partner will enter into a side letter with the state of Wyoming in connection with our admission into the fund, providing our customary most favored nations provision. Regarding indemnification and exculpation, the fund will indemnify indemnified persons as set forth in the LPA. and the fund does recognize Wyoming law. Regarding sovereign immunity, the state of Wyoming will enjoy sovereign immunity protection, and the general partner will enter into in the side letter and provide the investor with our customary sovereign immunity provision. And finally, arbitration, the general partner confirmed that the LPA and any other fund documents do not require the state of Wyoming to consent to arbitration. And with that, I will yield to any questions.
Are there any questions? Caleb, just one for me, and I think it's just from this levering issue. What percent of the fund are we? Do you have any idea? And that you don't have to answer it if you don't know, that's fine.
Thank you, Mr. Chairman, Mr. Governor. At this point in the capital raise process, I believe we currently represent 25 to 30% of the fund. So the final fund target is going to be $1 billion for the initial capital raise.
Okay.
So steady state, we will represent approximately 10% of the fund as of first half of 2023.
Okay, thank you. Mr. Secretary.
Just one quick comment. I noticed they're a Delaware limited partnership, and I'm just kind of curious as why they're not a Wyoming one. We have much better laws. Anyway, that's
Thanks. I was going to make that comment, Carl. Good. Representative Stiff.
Yes, Mr. Chairman, thank you. Just a question about the venue provision. Is there a venue provision in the agreement?
Mr. Chairman, Mr. Representative Stith, I am not aware of a venue provision. We will have to go back to our legal counsel.
And Mr. Chairman, I guess just as for suggest that the Wyoming Chancery Court be designated as the venue for disputes.
Yeah, Mr. Chairman.
Mr. Treasurer.
In the material terms, it looks in the comments, it says jurisdiction. And I think that's what that you're talking about, Representative, and it's Wyoming courts. So it's not only the Chancery Court, it's Wyoming courts, which could include the Chancery Court.
Yeah. And Mr. Chairman, I would suggest that the Chancery Court be given the exclusive jurisdiction, because if you do have a dispute, you'll want it to be resolved quickly, and you don't want Wyoming's case to get stacked behind the regular civil docket and criminal docket of a district court. That would be my, preference if possible. Thank you.
Thank you, Representative. A very good suggestion. Mr. Treasurer, I think you can take that into consideration.
Yeah, and I think we had that area discussed earlier, and we were going to, with our last council, previous council, we're going to address that. However, it did not get in this one here as to give preference to the Chancery Court, and I think that we can. So I don't see any problem with giving preference to the Chancery Court.
So, Representative, good suggestion. We should talk about some things about that, because it, as you know, has the ability for either party to withdraw from the Chancery on will if they want to. So, very good. Anything more on that, Mr. Treasurer?
No, Mr. Chairman. No, Mr. Chairman. The state treasurer recommends that the board approve the material terms of the state investments in the Angelo Gordon Direct Lending Evergreen Fund.
Motion's been made by the treasurer. Is there support?
Second.
Mr. Secretary, I was about to give it to you in case she jumped you. So, very good. They're moved and seconded. Is there further discussion? Hearing none, all in favor signify by saying aye.
Aye.
That motion carries. Congratulations. Thank you, Mr. Simpson.
Thank you, Mr. Chairman.
Thank you.
Mr. Fleming.
Mr. Chairman, the next fund would be Adelia Asset Management, and Caleb will talk about the fund now.
Thank you, Patrick, and thank you, Mr. Chairman and the board. It is my pleasure to bring the second recommendation for this morning. The second recommendation is I am recommending an investment of $100 million into Adelaya's Asset Income Fund Evergreen. As I did before, I'll quickly run through some of the high-level fund terms, and then I'll walk through my thesis and why I'm bringing this fund forth today. So this $100 million commitment would represent if the fund achieves its fund target of $1.75 billion, just slightly north of 5% of the total fund. They're targeting an 8 to net percent. It's going to be, given the market conditions, maybe slightly higher, but approximately a 10% net unlevered return in this fund. Targeted distributions in a similar manner to the prior investment manager will be in the range of 6 to 8% annually, and we will receive distributions on a quarterly basis. The liquidity terms, in a similar manner to the prior fund, this will be an evergreen vehicle, actually the first evergreen vehicle of its kind for Atalaya. And liquidity terms, we are subject to a 3-year lockup with rolling 3-year investment periods subsequently, and with a redemption option every 3 years with a 1-year notification period, with proceeding slow pay liquidity as the assets amortize and pay off. Really, the reason I'm recommending Atalaya is that it truly represents the best in class in asset-backed lending, in the especially finance space. It is very rare to find someone in this space with the long track record and tenure that Atalaya offers the state of Wyoming. Ivan Zinn founded the firm in 2006. We were fortunate to be joined by one of his colleagues and founding partners, David Adey, this morning as well. The firm is launching its first, if the firm launched its first closed-ended vehicle dedicated to the space in 2012, and they now have 5 closed-end vehicles as part of their historic track record. The AIF Evergreen strategy will be the first of its kind and will predominantly originate senior secured loans to specialty finance companies in the United States. The fund will provide broadly diversified exposure to pools of consumer loans, as well as to pools of SME, or small and medium enterprises as well. Now, Atalaya will focus on pre-securitization specialty finance companies with very attractive credit attributes, such as, that really results in a significant illiquidity and complexity premium relative to public market equivalents. These assets will have rapid self-amortization, structural protections, and backup servicing. The market opportunity is substantial. It's over $2.5 trillion and growing, and presents a phenomenal opportunity set driven by continued bank retrenchment. Atalaya's team has generated exceptional risk-adjusted returns since the inception of this first style of fund, with a net IRR of 9.5% over the last decade. The fund will be a great complement to the other current and future strategies in the private credit portfolio. Atalaya's first objective is preservation of capital. As you heard with Angela Gordon, there's a theme here. The loans will be characterized by conservative advance rates, tight credit boxes, and multiple covenant packages. The team has invested over $4 billion in these strategies across 100 investments. The fund will be unlevered. That's key here, and will provide a robust level of income-driven returns from a portfolio of assets that are extremely well insulated from the broader economic or market cycles. As evidence, I would offer up their 9 basis point historical loss ratio. Where are they going to be investing? They're going to be investing in predominantly consumer loans, as Mr. Keevan pointed out earlier, as well as some small and medium enterprise loans. So that could be business credit cards, other business receivables, et cetera, constituting a portion of the fund. And in summary, Atalaya offers unrivaled industry expertise going back to 2006, active access to an extremely attractive risk-adjusted investment universe, and top-tier risk management. And with that, I submit to the board.
Thank you, Mr. Simpson. Questions? Okay, Mr. Fleming. Is Josh going to comment on this then too? Or he already has, I think. Unless you want to bring it back, and then Mr. Lay has also done the same, so.
No, Mr. Chairman, I think Josh and both Mr. Lay have commented and told you what they're looking for. But I would like to introduce David Adey and also Lynn O'Connell, who is the investor relation business development individuals. And also, it's just nice that both of these managers had the opportunity to present via Zoom, and they both chose they wanted to be here. In person. They are looking for much more of a long-standing relationship, which is consistent with what we're doing. So it's nice that we're able to get back into the in-person relationships. So with that,
Thank you very much.
introduce the managers.
Thank you very much for coming. It's always nice to see people come to, we love to have you come and see what great laws we have, business laws. Delaware sort of stinky next to the swamp. Well, here we are, clean, wonderful. So wonderful
It's
to
our
have
pleasure,
you.
Mr. Chairman. Thank you for having us today.
Thank you.
And we have a 1,000-year trust, too, so.
Oh, fantastic, great. Just while we get the presentation up, good morning, everyone. Thank you so much for inviting us here to present to you in person. My name is Lynn O'Connell. I've been with Axia for about a month now. I'm a senior director there. I actually joined from Axia, where I was a private credit consultant for almost 11 years. As mentioned, joined by David Adey, one of the firm's partners and co-head of the strategy that we will be discussing this morning. As Caleb mentioned, the opportunity that you are evaluating today is a $100 million commitment to Adelaya's Asset Income Fund, or AIF as we refer to it. We really look forward to the potential partnership with you all and appreciate the work that Caleb and his team and RBK have put into due diligence in Atalaya. If we turn to slide 3, thank you. So Atalaya was founded in 2006. Today, we currently manage about $9.5 billion. Since inception, we've invested over $14 billion. The firm is majority owned by its partners, most of whom have been with the firm for well over a decade. We invest across 3 verticals. The largest and most applicable vertical to the AIF strategy is the specialty finance vertical highlighted in gold. As mentioned, AIF is a specialty finance strategy focused primarily on lending to small business and consumer lending platforms, making very senior loans that are directly backed by assets as collateral. Many of our investors find AIF to be a nice diversifying complement to the corporate lending strategies that they typically have in their private credit portfolios. I'll now hand it over to David to talk about his team and the strategy in a little bit more detail.
Great. Thank you, Lynn. First, I'll echo what Lynn mentioned, which is we're excited to be here today and to hopefully establish a new relationship with you all and to grow that over time. So thank you for your time today. In terms of the organization, if you want to flip to the next page, the firm at Atalaya is a little over 100 people at this point in time. And that's roughly evenly split between investment professionals and business management, as we call it. And in terms of offices, unlike Angelo Gordon, we're relatively simple. We have 2 offices. We have one in New York City, which is our headquarters, and the other one is in Dallas. And in terms of retention, that's something that we pride ourselves on, that we feel that we've actually had a quite stable leadership at the senior level, in particular at the firm, and a number of folks that we won't go through everyone here, but I will highlight a couple elements of the organization that we think are a bit different than a number of our private credit peers. First and foremost is that we actually have a dedicated data science effort. So if you are invested with hedge funds, as an example, I'm sure that's old news. Most people who don't have a dedicated data science effort on the hedge fund side probably long ago have been either fired or put themselves out of business. But as it relates to private credit, that's actually relatively novel. Very, very few of our competitors have a data science effort. And in particular for our strategy, because of how asset intensive it is, the amount of data that comes along with it is really, really extraordinarily large. So large, in fact, that most of the data tapes will not fit in Excel. So Excel actually has a finite number of rows and columns. And in order to run our analysis, we need to use a programming language like Python or R. So we have a dedicated arm of the firm that does that, which is a real competitive advantage for us to effectuate this strategy. The second element I would highlight of our organizational chart is our asset management team. Our asset management team is intimately involved with all of our transactions before we close them. So I'll get into some of the bells and whistles later as to why our strategy is unique and why it's so labor intensive, but that is a key area of strength for us and a competitive differentiator. So if we move on to the next slide, we can talk a little bit about the AIF strategy, as we call it. Really, in a nutshell, Lynn mentioned it, but at the heart of it, if I'm speaking plain English, really what we do is we lend to lenders. That's the heart of the strategy. It's a very uniquely defined niche. And as Caleb mentioned, we are specialists in asset-based lending. So Trevor, who was here before from AG, was mentioning all of the corporate direct lending that he does, clearly has a great track record. What we do is, to some degree, actually almost the opposite of what Trevor does. So what Trevor's doing in Angelo Gordon is he's underwriting those businesses and looking at them from an enterprise value standpoint. You never, ever want to have to liquidate one of those businesses that he's lending to. In our strategy, we actually look at it through a liquidation value lens purposefully. The vast, vast majority of our transactions actually don't go into a liquidation, but that's the underwriting. So we underwrite each of these transactions assuming there is a liquidation, and we want to have a very high degree of margin of safety in the event that we do go through a liquidation. So as Caleb mentioned also, we've done well over 100 transactions in the strategy dating back to 2012. Out of that ballpark 150 or so of transactions, 11 of them have actually gone in, 11 of our lending transactions have gone into a wind down or a liquidation. Of those 11, we have recovered principal in all 11, and we've recovered our full contractual return in all 11 as well. So as an example, those transactions were underwritten to about a 14% unlevered return. When we had to wind down those transactions, we recovered all of our principal plus the 14% IRR almost to the dot. So the hallmark of our strategy is a reliance on the assets themselves and not on the capital markets, not on a sale to a financial sponsor or a private equity firm or an IPO or an M&A deal. The entire crux of the strategy is centered around liquidation of the assets, even though, with a big asterisk, we obviously hope to never have to liquidate. So most of the time we don't liquidate, but when we do, it tests our underwriting. So to highlight here, again, asset-backed strategy, which is a big differentiator versus what you're going to see with most of the other folks that come in to talk about private credit for you. And two, we talked about downside protection, that we're 11 for 11 in those liquidations. That has driven our extraordinarily low loss ratio. So Lynn mentioned what we lend to lenders. That's about 80 to 90% of the strategy. The other 10 or 20% is actually purchasing some of these short duration assets that liquidate out. So the same type of assets we might lend against, we might purchase as well. And obviously we target slightly higher returns when we're purchasing assets and owning them ourselves. In that purchase bucket, we have had some losses. And those losses, though, have been small enough to the point where on an aggregate basis, when you look across the strategy, our loss ratio is inside of 10 basis points. And so relative to private credit firms that have deployed billions of capital like we have, at least I personally haven't come across a strategy that's had quite that low of a loss ratio. So we're quite proud of our focus on downside protection. A lot of people talk about that, but in terms of the track record here, it actually is backed up. On page 6 here, on page 6, we're the stepping back when we talk about lending to lenders. The reason why this is a growing space for us is because of also what Trevor mentioned, which was the theme of bank retrenchment. So post 2008 in the global financial crisis, a lot of banks have stopped lending as much to small businesses and consumers. It's become inefficient and regulatorily difficult for them to do that. So there's a lot of what's called fintech companies. That's probably a term many people have heard. where they're stepping in to fill the void. They're providing capital directly to consumers using technology, or directly to small businesses using technology that looks at their bank accounts and helps determine in a more sophisticated way who are the creditworthy small businesses and consumers and who are the folks that really shouldn't be accessing capital. So it's that subset of firms that's our target market. So we are lending to firms that are lending to consumers and small businesses. That's at the heart of it, what we're doing. And that market opportunity, frankly, is quite large. It sounds very esoteric. It sounds weird. We're probably the only manager that's come in here that's described this strategy. But despite the fact that there's not many of us that do this strategy, it's actually quite a large market opportunity. It's about $2.5 trillion in size, and we're just a very small fraction of that, and it's growing quite quickly. If we move on to the next slide, in slide 8, this is again a relatively esoteric and maybe complex chart to understand. But what we're trying to explain here is that relative to very well-trodden, very liquid public securities, the yield premium that Atalaya generates for effectively the same risk is extremely high relative to public comparables. So most direct lending managers that come in will compare themselves to the levered loan market. And they'll say, you're going to get a roughly 200 basis point premium, illiquidity premium, for going into the lower middle market versus larger companies that are accessing the levered loan market. Our yield premium, when you look at the exact same securities in the public markets, tends to be somewhere between 500 and at times 1,000 basis points yield premium for the exact same risk. Now that doesn't seem to make a lot of intuitive sense why that would make sense. The punchline of the question of why is this is an extraordinarily labor-intensive strategy. So I talked about data science and I talked about our asset management arm. The amount of work quotient relative to deployed capital is extraordinarily high in this strategy. It's not quite as simple as a direct lending strategy where you might write a $50 million loan, wait 3 or 4 years and get repaid that $50 million and just collect interest checks every month. What we're doing is actually working directly with those companies to reconcile their data tapes and the underlying assets. That's our collateral. And that amount of work is extraordinarily detailed and labor intensive. Hence, there are very few competitors that do what we do. When RVK said that Angelo Gordon was the best idea, my guess is they probably went through 50 or more direct lending managers to come to that view. I would venture to guess, and I can't put words into RVK's mouth, but I would venture to guess that you can probably count on one hand the number of firms that they decided to diligence when looking at a similar asset-backed specialty finance strategy. So because there are so few competitors, we are able to drive pricing that's much, much higher than where the public securities say this type of risk should price. Hence, we don't need to use leverage for this strategy. That's a very, very big distinguishing factor. So we are providing this return stream to investors on an unlevered basis because of the return premium we're able to generate. If we move on to the next slide, this is just a simple visual that helps to hammer home the point of why we feel the strategy is so much lower risk than a traditional corporate lending strategy. Again, we think that direct lending makes a lot of sense in portfolios. We're fans of that. We think that our strategy in particular actually offers quite a bit of a differentiated downside protection because of the amortization profile. So if any of you in the room have a credit card that once in a while you might hold a balance on, or if you have an auto loan that might amortize over 3 or 5 years, that's an example of the type of asset we might lend against. Even a home mortgage, we generally don't lend on 30-year assets. Our assets are much shorter duration, but that's another example of an instrument that has a combination of interest and principal all along the way. And so if you think about your home mortgage, the minute that you get your home mortgage, you're at your maximum loan to value. You might have an 80% loan to value, but every single month you make a payment, you're making a little bit of a principal payment alongside of that. So in month 2, 3, 4, and 5, your loan to value, if you assume the house is a constant value, actually decreases month over month. The same concept applies here in the income fund. Every single month we have some amortization, our risk profile is decreasing. This is a slide that I'd love to have the chance to walk through with you all if we had more time today. And if we come back, we'd be happy to do it. Or if you come to New York, we're happy to have you in our offices to walk you through some of the bells and whistles as to how we monitor these investments, how we underwrite them, how we covenant them. But the punchline of all of this is we actually have control of the cash. So when these small business lenders and consumer lenders are originating assets, all of the underlying small businesses and consumers are actually making payments directly to a special purpose vehicle. That's our borrower. They're not making payments to the originator. And in terms of that special purpose vehicle, only Atalaya has disbursement authority over the cash in that vehicle. So that means at the end of the month, the company that originated those assets is actually waiting for Atalaya to disperse the money back to them. So first we pay ourselves interest and fees and amortization, and then we release the money back to the company if they're in compliance with the covenants. So that's a very big distinguishing factor. Again, compare and contrast versus traditional direct lending, where you send the money out and wait for your interest to come back. In our strategy, the originating company is actually waiting for us to send the cash to them. And moving on, just in conclusion here, I'll give you a little bit of the pitch on why Atalaya. First, I think it really boils down to two things. First and foremost, we've been running the strategy for quite some time. As mentioned, we first launched this in 2012. At the time, it was an entirely novel concept to have a dedicated fund for asset-backed specialty finance. There was no one else in the market that had this product. Since then, we've had 5 different funds. This is now our 6th fund. Due to LP demand, we have changed the fund structure from a drawdown private equity style fund to an evergreen structure where LPs can choose their duration. But we are the largest specialty finance asset-backed lender in the United States. And so this is just a strategy we've been running for a while. We have a lot of experience doing it, and the track record we think is quite strong. And 2, our strategy is quite unique in that the crux of our investing actually relies on repeat relationships. So just as we hope to endeavor to start a new relationship with you all and then grow it over time, the same concept applies to our portfolio companies. So unlike direct lending, which we would argue suffers from some adverse selection, we have positive selection bias. And what I mean by adverse selection, your best corporate direct lending managers will probably admit that their top performing portfolio companies, whenever those companies double or triple or quadruple EBITDA, the very likely result of that is they're going to get refinanced with a much lower cost of capital. That's just reality. In our business, the more successful these platforms are, actually, conversely, the more capital they need to consume from Atalaya because they're growing their loan book and they're doing well. So we call that phenomenon letting our winners run. So we actually have a pretty strong positive selection bias in our strategy. That's been a hallmark of it. About 3/4 of the fund's deployment in recent vintages have been through winners that are running. So repeat relationships that we're either upsizing or doing a new deal for because they've grown so much that they need to provide that they need a new debt facility from us. So I'll conclude there, and I'm sure I threw a lot of information at you, and we may be the only manager to offer this type of strategy to you. So I'm sure there may be questions. I'll pause there.
Thank you. And, any questions, Mr. Secretary?
Thank you, Mr. Chairman. Just one question I have. As with the previous one that we were looking at, we have a 6-month notification to pull out, and you guys have a 1 year. Is there a reason why that we need to have that far out on that notification?
Just from our perspective, it'd be helpful from a capital planning perspective to know a bit more in advance if our LPs are going to stay with us. So if they're going to stay with us, if not, our need or preference will be to replace that capital, and we'd like to have an adequate time to do that.
Follow-up? No. Other questions? Madam Auditor.
And I don't necessarily know that this is something that you invest in, but on the profile page of the market, page 6, what is online alternatives and merchant cash advance?
Online alternative.
I'm guessing it's maybe something you don't play in, but I'm just curious what it is.
Sure. So, there's all sorts of, I'll give an example of that might be a company that some of you may be familiar with called Square. So Square is a merchant processor.
Yeah.
If you go to a coffee shop or a deli, they might accept that. And Square has an arm of their business that not only does the payment processing, but does lending as well. So they might do extraordinarily short-term loans to coffee shops or, New York, we call them bodegas, delis that you might find on the corner of the streets there, pizza shops, et cetera. So relatively small service-oriented businesses in the basic economy often have working capital needs. So it might be in advance of Christmas season, they need to have a buildup of inventory and they might need a relatively short-term loan. So Square provides loans to those businesses that use their merchant processing. They have a data science team that analyzes what types of merchants would be creditworthy for extensions of credit. And Square Capital keeps some of those assets on their books, but actually desires to be a relatively more asset-light business. So that falls in the fintech bucket I mentioned earlier, where it's really hard to exactly say, that would be a form of merchant cash advance. So they're advancing those merchants cash and they're receiving back somewhere in the order of, in Square Capital's example, somewhere between 10 and 15 cents of every dollar they lend out, they get returned back to them over some period of time that's ballpark 6 months. So really short duration in nature. And that might be an asset that we would, as an example of an asset that we would lend against or we would purchase, because it generates a yield and amortizes down relatively quickly.
Thank you.
Thanks. Two questions. Did I understand you, so in the process of the mortgages, the payments are sent to you, correct?
Correct.
So the servicing piece of that must be a prodigious task if you're talking across all of that.
We definitely don't do all the servicing from New York City. In fact, Atalaya so there's 2 layers of servicing that I would think about. We service and asset manage our investment. So our investment is the loan to the special purpose vehicle. The special purpose vehicle, or that originator of the assets, if they're originating mortgages or credit cards or whatever the asset is, typically the originator is also the servicer.
Okay. So that's the arrangement, yeah.
Correct.
Great. And is it mostly Case-Shiller markets that you're looking at, or do you sort of do a broader scope than that?
Sorry, when you say Case-Shiller, what do you mean by that?
Well, I mean all of those sort of major metropolitan areas.
Sure, yes. Our exposure in Atalaya is, I would say ballpark 80 to 90% US centric. The other 10 to 20% is roughly UK and Canada. But within all those countries, whether it's US, Canada, or UK, we're broadly diversified really across the country. There might be a few exceptions here and there where we might have a specialist lender that's focused on a certain geography, but let's just call it 95% of the exposure would be broadly diversified in accordance with how GDP is distributed. So you can probably imagine California is our largest single exposure in the US, probably followed by Texas, New York, et cetera, in terms of sizing.
Okay, thank you. Further questions? I hear none. Thank you very, very much for being here. Really appreciate it. Mr. Treasurer.
Thank you, Mr. Chairman. And I guess both you guys are in New York, so your data thing is in Dallas. Is that we have a lot of data down there? Is that right? Or
Our data science team actually is based in New York.
it is?
Yeah, but we are starting to. We opened up the Dallas office within the past year, and we are growing that at a healthy clip. We're finding the talent base there is.
Well, when you get big enough to do some of the investments like Microsoft and Facebook have in Wyoming because of our excellent climate for basically the servers and those operations just come here. The governor is open for business.
Excellent.
Thank you. Also, Mr. Chairman, I recommend that the board select the fund Atalaya Capital Management Asset Income Evergreen as a state private credit investment manager, conditioned upon the approval of material terms and successful contract negotiations.
Thank you, Mr. Treasurer. Is there support for the motion?
Second.
It's been seconded by the auditor. Is there any discussion? Hearing none, all in favor signify by saying aye.
Aye.
That motion carries. Congratulations. Thanks very much for being here.
Wonderful. Thank you very much.
It's really interesting.
Mr. Fleming.
Mr. Chairman, proceed with terms and conditions.
Thank you, Patrick. Thank you, Mr. Chairman and the board. I will now offer up a summary of terms and conditions for the Atalaya Asset Income Fund Evergreen. This fund is a Delaware limited partnership with the general partner being Atalaya Capital Assets Evergreen, a Delaware limited partnership that serves as the general partner of the partnership and each underlying pool. The manager is Atalaya Capital Management. And I will now go into the investment guidelines. One of the investment limits that was highlighted in the key terms is the general partner will not cause a pool to invest more than 20% of the aggregate pool capital commitments in investments representing credit exposure to any one particular issuer or borrower. The general partner will not invest in direct or secondary investments in open or closed private or closed-ended private and collective investment vehicles that are managed by the investment manager or any affiliates that exceed 20% of the capital commits. And going down, the general partner will not invest more than 15% of the aggregate capital commits in CDOs and CLOs. And in connection with utilization of derivative instruments for purposes other than hedging, the aggregate notional exposure to non-hedge positions will not exceed 25%. Regarding term commitment and period termination, as I touched upon in my initial introductory remarks, the initial investment period is 3 years and will also be subsequent rolling 3-year periods at the end of that first 3-year term. In addition, there are a number of mechanisms for termination of the investment pool, one of them being consent of at least 80% in interest of the limited partners of such pool based on capital commitments attributable to such pool in accordance with the partnership agreement. Regarding removal of Atalaya as the general partner, it requires 80% in interest of the investing pool. The limited partners are able to either dissolve, wind up, and liquidate such investing pool or replace the general partner or the general partner of such pool and approve the investing pool's advisory committee's nomination of a replacement general partner if they meet that 80% threshold. Regarding limited liability, like Angela Gordon, the general partner did acknowledge that the investor, like other LPs, will not be liable for any obligations of the partnership and will have no obligation to make contributions to the partnership in excess of their respective capital commitments specified in the partner documents. Regarding leverage, the partnership expects to cause the pools to incur indebtedness on a short-term basis. However, they do not anticipate the application of any long-term leverage, and the short-term leverage will not exceed an amount in excess of 30% of the aggregate pool capital commitments. Standard disclosure notifications of 120 days for reporting. They've agreed to abide by the Wyoming Public Records Act. Regarding standard of care, similar to Angela Gordon, it represents and warrants, the general partner does, that it is currently registered as an investment advisor with the U.S. Securities and Exchange Commission, and it agrees to maintain such registration. Regarding an advisory board, unlike Angela Gordon, Atalaya will have an advisory board in which we will have a seat on this particular fund, on the LPAC. Most favored nations and indemnification, Atalaya has agreed to the same provisions as we have negotiated, we will negotiate under successful approval in the side letter. Regarding sovereign immunity, the general partner and the partnership have agreed to the Wyoming laws and statutes regarding sovereign immunity and their applicability to this board, as well as the Wyoming State Treasurer's Office. I now submit to the board for any questions or points of clarification.
Thank you. Any questions from the board? Hearing none. Thank you very much, Mr. Treasurer.
Thank you, Mr. Chairman. I recommend that the board approve the material terms of the state investment in Atalaya Capital Management Asset Income Evergreen Fund. Oh, wrong one. I wonder why that one popped up. Should, I think, conditioned upon the approval of material terms and successful contract negotiations.
I think, Mr. Treasurer, you actually were on the right one, D2.
Was I?
D2.
Oh, okay. All right. I thought we had gone. All right. Okay. Recommend that the board approve the material terms of the state's investments in Atalaya Capital Management Asset Income Fund Evergreen.
All right, thank you. Is there support for that motion?
Second.
It's been seconded by the secretary. Any discussion? Hearing none, all in favor signify by saying aye.
Aye.
Thank you very much. That motion carries.
Just one comment.
Sure.
Mr. As with Angela Gordon, would be sure happy to bring them over to Wyoming as a limited partnership so they can have some better terms in Delaware.
And I'm sorry, I saw Representative Stith, you were blacked out. I looked at you before we went to that, but I didn't see your hand up, so I apologize. I recognize you now.
No worries, Mr. Chairman. Again, same issue about the venue provision in the contract. I just think it's important and useful for the state to have venue in the Wyoming Chancery Court. You know, there's a reason that Elon Musk is going to buy Twitter, and it's because the Delaware Chancery Court is on a rocket docket. I love my district court judges here locally. I have a trial scheduled for November the 9th, 2022, in a civil case that was filed in December of 2017. So there's a big difference between Chancery Court and District Court when it comes to getting disputes resolved, and I think it's going to be in the state's interest to get the disputes resolved quickly. So same issue, just kind of being repetitive here, but I thought I'd keep pounding that drum. Thank you.
Perfect. Thank you, Representative. And well, Mr. Treasurer, I hope take that under advisement.
And Mr. Chairman, I would hope that in the negotiations of the contract I don't believe it would be inappropriate to see whether or not Atalaya and the other folks, would approve the Chancery Court. I see no reason for them not to. But I think these were kind of negotiated prior to this. But if that's I guess, open for optionality, Mr. Chairman, or do you think that we'd have to change the motion to allow that optionality?
I think you can take it under advisement and move that ball that way.
Okay, thank you, Mr. Chairman.
Thank you. All right, Mr. Fleming.
Duly noted. We will look into the Chancery from now on. With that, Mr. Chairman, I believe we will continue on. Josh Keevan will give you an update on the August numbers for the performance.
Okay. Mr. Keevan.
Thank you, Mr. Chairman. I'm going to start on page 2. Just a couple comments on the market environment. Big picture, to sort of restate some things I know we've talked about over the past several years. Big picture perspective, after nearly 40 years of markets that were characterized by falling interest rates, increasingly easy monetary policy, and investors in the investments that generally work the best in that environment, real emphasis on growth and price appreciation. We've entered a very different environment, and that environment is one in which the Fed is not able to ease in the face of growing economic weakness because their first priority needs to be inflation. And you're seeing significant increase in discount rates. And so from an investment landscape perspective, on page 2, I'm going to draw your attention to the column on the left-hand side of the page, but the farthest right, where it says CYTD, or calendar year to date. That's the 8 months ended August of 2022. The assets that are doing the best in this environment are assets that are generally where the cash flows have some connection to inflation. At the top there, you see MLPs up 26%, so midstream energy assets doing quite well. You see that to some degree with real estate, where updated every quarter. Sometimes it just takes longer for economic reality to sink into those prices. Real estate and private equity are both benefiting from that. Third best asset this year, cash. So cash is, I think we're all trying to figure out is cash king now, or is it just better than most other things? But probably remains to be seen there, but
Kind of like 2008, isn't it?
a little bit, except for in 2008, duration was a good thing to own. It's a horrible thing to own this year. So it's, in 2008, your portfolio benefited from conservative asset allocation, lots of fixed income, lots of safe duration. You're doing relatively well this year, and it's actually because you've gotten rid of a lot of that in favor of diversification. And as we think back to the asset allocation changes you made, especially 2 years ago, the theme was how can we pivot from assets that are going to rely on PE expansion to assets that are going to have income and durable income and resilient income. The two managers you just heard from today are great examples of that. Your transition approach to really kind of get, not abandoned completely, because we need some deflation protection in the portfolio, we need some duration, but you cut that down significantly towards shorter duration assets, more floating rate assets, and that's a big reason why you're holding up as well as you are this year. At the bottom of the page, you see equities. Near the bottom of the page, you see the aggregate bond index, which is, again, kind of that safe duration. Not surprising at all. These are, if you look at the duration of the ag, and if you told us that, the 10-year treasury yield would be up as much as it is, this is about what you'd expect from bonds. It's also about what you'd expect from equities, just based on duration estimates for equities, which is a little bit trickier to pin down. But not surprising at all that these are the returns we're seeing for those types of assets. The good news is you've been relatively well positioned, as I noted. And if you move to page 4, this is looking at all of the assets. And keep in mind, again, total fund is everything from long-term endowment, permanent fund assets, to short-term, more working capital type assets in the state agency pool. So here it's less about the total absolute return and more about the relative performance. As a group, how are you doing relative to your benchmarks that are in your policy? Calendar year to date, you're exceeding that by 30 basis points, and this is net of all fees, and exceeding that over the past year as well by about 30 basis points. You do see the quarter to date and fiscal year to date, that's just the July and August period. July was a good month. That's, when markets rebounded in July, that's where you saw some underperformance. August was a bad month. September is going to be a bad month, or was a bad month. The U.S. equity market was down something like another 9% in September. So I wouldn't read anything into the near-term relative underperformance. September will be much more telling in terms of where you're at this year. As you turn to page 6, just to point out a couple of the primary funds here. Permanent Mineral Trust Fund, I'm just going to focus on the calendar year to date and the 1-year period. Down 6.5%. The 70-30 benchmark, so that's that's the risk sort of limitation that's in statute. It's also a proxy for just simple public market, typical endowment type of allocation. You have held up so much better than that. It's worth noting, I believe, here, down 6.5 when that's down almost 10% more. So in a bad environment, you're looking really good relative to what the statutes say about how much risk you can be taking. As you go out over 3 years, where we still have positive returns, you're also beating that by quite a bit now. Now, if you go out to the longer term, 10, 15, 20 years, it kind of depends on which period we're talking about. 10 years, you're a little bit behind 70-30. 15 years still includes 2008, so that you're a little ahead there. But if you go out long enough, over 20 years, it has been a good environment, the last year or so notwithstanding for that type of 70-30 portfolio. The Common School Permanent Land Fund, that's one of the income-focused funds, and the income-focused strategy is actually holding up even better this year, down about 4.7, and over the past 12 months, only down 2.5. Workers' compensation, this is where you have the most duration in the assets, because here you are intentionally matching up assets to projected liabilities. And if you look at the projected liabilities for workers' compensation, that's roughly 10, maybe a little bit more than 10 years of duration on those liabilities, according to your actuary's most recent report. The plan's really well funded, so your approach here has been to essentially match up a portion of the assets with those projected liabilities. So although in return-only space, this looks a little bit worse, you're actually just sort of matching what's happening as well on the liability side for much of that. And then I'll conclude on page 7. LISRA, also down about 6.5% year-to-date. LISRA is made up of 3 underlying subcomponents, and so there's a short-term reserve, an intermediate-term reserve, and a long-term reserve. Short-term reserve is where the largest allocation is, just based on projections for liquidity needs, and that is just in short-term, high-quality fixed income. But even short-term, high-quality fixed income has some duration risk, and that's why that's down 2.8% this year. Pool A, we'll probably need to choose a different color here for background because it's about the same as the red on the negative numbers, but that's down 5.9% year-to-date, and state agency pool as well, down about 2.5%. So, Mr. Chairman, those are my high-level comments on the performance update. Overall, we are pleased with how your asset allocation is serving you in a very difficult environment, but the landscape continues to evolve, and yields are much higher now, so it'll be interesting, I think, next spring as we come back to asset allocation and take a fresh look at this. But I'll pause there and answer any questions that you have.
Thank you, Mr. Keevan. Any questions? Any questions? You explained it well.
All right.
Thank you. Mr. Fleming.
Mr. Chairman, D6 would be consult with the board on the modification of the spending policy amounts. I don't know if, Mr. Treasurer, do you want to comment on that?
I'll do that, Mr. Patrick. Yeah, Mr. Treasurer, excuse me, Mr. Governor, second time I've said that. I keep thinking of you from time to time as treasurer. You just can't get away from that job. What we're doing here is a little bit of a switch. Normally, we just kind of kept the same way, but here we kind of stepped out and wanted to give some direction and help give some direction to the legislative process and in the areas of the reserves and also in the areas of the spending policy and as far as putting a cap on it. And so what we're recommending is that in the areas of the reserve accounts, that it's a minimum of 5 times and that we put a spending cap and do this in a constitutional manner, Mr. Chairman. And the reason for that is that as we move into more of a total return aspect, I think we want to have a little more protection constitutionally as trying to keep the legislative process from raiding the reserve funds and trying to keep them from not getting too excited about spending more money than over the long run we can actually expect to be able to generate. And I know that Mr. Keevan has done a lot of work in this area as far as the recommendations on reserve funds and spending caps. And if you would allow him, Mr. Chairman, I think that he can give everybody basically a third-party representation of what is kind of usual and normal and or best practices.
Mr. Treasurer, that sounds fine. Let me ask one quick question though. Normally, and I think this is statutory, so Matt, I don't know if this makes sense. There is a percent spend policy that is kind of the view of this, and so I guess it does seem to me appropriate to recommend and for the members of the board, this is somewhat academic because the legislature does whatever it feels like. But I think this is an appropriate recommendation. But I also just wonder if we want to recommend, and I think we've normally been in the nature of like 4.5, and they always say 5, but I don't know if that would make sense, Mr. Treasurer, just to.
Yeah, Mr. Chairman, I think we could put that on the top, is that the recommendations remain as, the same statutory levels and of what is currently available. And I think it's 5 for the common school, and it's a guarantee of 375 for the PMTF and up to 5 for if the funds are available.
Okay.
Yeah.
Madam Auditor.
And Mr. Chairman, I think, to your point that this is a reasonable recommendation, I believe CapFin just is moving forward with a bill draft to do the 5 times. So I think that would maybe express our
support of that.
Enthusiasm for that effort.
Yeah. I think what they're doing is maybe a little light from what I'd like to see. I think they're moving forward with a recommendation of a cap, but to do it, allow with a 2/3 vote of the legislature to raise it. And I'm really looking more like, Josh can speak to this, New Mexico that has a constitutional cap. Now, so I'd kind of like to hear from Josh, so he kind of gives everybody the perspective that we've been working with.
Thanks, Josh.
Great. Thank you, Mr. Chairman. Treasurer, I'll try to be relatively brief on this. This is a topic that's near and dear to my heart. We have studied it extensively, and I can go on, but I'll try to be brief here. If you want to talk about best practices, we would say look to the higher education endowments, where they have adopted a true total return approach, a percentage of market value distribution policy, and sort of constant diligence on what can the markets actually support that's sustainable in terms of that distribution policy. With the state sovereign wealth funds in the U.S., both the land grant school funds like Common School, as well as the severance tax funds like the Permanent Mineral Trust Fund, it's such a wide array of circumstances out there. So there's lots of examples, but the unique challenge, especially if you go back to sort of the land grant school funds, they go back to statehood. A lot of the challenge with doing what the higher education endowments have done is language in state constitutions and usually in also the acts of admission or enabling acts of those states that describe a sort of what we would call a sort of 19th century view of finance, which is income shall, something to the effect of only income shall be distributed and all income shall be distributed. That works reasonably well when interest rates are high enough to support that, although it still has some issues. But modern finance has really sort of moved away from that, as have the higher education endowments. So what you see across the landscape of different states is sort of various levels of attempts and strategies to try to navigate that. It's very difficult to, and you know this well, it's very difficult to fund a 5% spending policy when the capital markets don't produce 5% of natural income on a portfolio. Well, we're getting back closer, obviously, to that, but I would say and the treasurer mentioned the New Mexico State Investment Council is responsible as well for their state's land grant and severance tax funds. They have actually gone to the effort and hard work to amend their state's constitution to remove that language and to embrace a sort of true total return endowment approach. And their constitution has it's not really so much a max, it's actually just a spending policy that is 5% in their constitution. The other end of the spectrum, you've got states that are still, really just managing to the income focus and letting that steer the asset allocation towards income and which invariably over time means more conservative, lower long-term returns and a greater challenge of meeting the goals of intergenerational equity. In the middle, there's a lot of sort of hybrid approaches where a feature of a lot of the hybrid approaches are larger reserve funds. States like Idaho and Utah would be examples of this, where they may have either no cap on the reserve funds, or in the case of Idaho, it's something like 7 times their annual spending policy amount. Having a larger reserve fund allows you to invest that reserve for a longer term time horizon, generate higher returns, and because it's larger, it can also weather more of a full market cycle. What you have now is something akin to like 1.5 times spending policy, and because it's so small, it's invested very conservatively. It's in the state agency pool. So from our perspective, anything short of sort of moving towards, embracing a true endowment model is going to have some issues with it. And anything in that kind of hybrid space is going to be imperfect. But if you know you have to live with this arrangement, this is a positive step in terms of at least allowing the portfolio to be more fully invested.
So, Josh, I think really good words there. Most endowments, I would submit, though, don't have politicians making the decisions about how you spend capital gains. And I think the big difference between total return and income is if you can devote capital gains as income. And if politicians are the ones that are making those choices, that is the sort of the biggest problem. So I think as you talk about moving to a larger reserve, which is great, and it does allow you to invest some of those assets longer term, but probably not as long term as the permanent mineral trust fund, because that's, you can't get it. Politicians can't rate it. And so, I think it is a wonderful, and Mr. Treasurer, I know you're working on this, and I think it's a wise and a correct move to do. But biggest issue I have is if the beneficiaries are the ones making decisions about how that money is going to be spent, just like we do here and just as New Mexico did, where they said we want 7% instead of 5%. The challenge is how do you protect that nest egg over time? And I think they're, the amending the Constitution, changing the active admission, those things are really important, and I think we can get to those. We also have to figure out who the trustees are going to be, because I don't trust us. I don't. This is a great board. These are very conservative people. We're supposed to have a conservative legislature, but I don't trust us. Every time that we put aside spending reserve accounts, we have put so many holes in the bottom of them and tips and drips and all that stuff. And it's all designed to make sure they don't function as an earnings reserve, but they function as a source of income so we don't have to pay for other things. So that's my only proviso in this. So.
Thank you, Mr. Chairman. I defer to your expertise on us, but I think those are wise words from my perspective.
Yeah, Mr. Chairman, I was hoping to bring this up to a discussion. I'm so glad I just heard you discuss it in the manner which you did. And I just set a spending policy cap, which would, it could go down, but it couldn't go up. I think the best protection we have is to place it in the Constitution. If I was going to make a recommendation, I would say nothing over 5%, because it looks like you're going to be able to do 5%, but had we had the same, 1%, 2% on our bond yields, going forward forever, I think that 5% would have been almost impossible to hit, because everything goes to the lowest common denominator, and eventually your real estate would go down, your equities would go down, and they would eventually end up returning you 1 or 2%. If at 20 years from now, had things not changed somewhat, not that I like inflation, and that's the reason why it's going up, but I think that and frankly, I think that if we can get a cap in the Constitution, that's the best protection we can as far as just total runaway spending, and taking it down to the last dollar before it's an inviolate corpus. And if we do an endowment model, then if you don't have constitutional provisions in the Constitution to protect that value of that corpus, then then you can have some serious repercussions there. So I think it's a conversation at another date. We'd like to have a lot in there, but I would be I think ecstatic with putting in the current legislative caps that we have now, like we normally do, just rubber stamp that, then add this language to it, and add a spending policy cap of 5%.
Sure.
And that's the minimum on the 5 times the spending policy as far as the reserve. That's the least you could possibly get by. And as you understand that, as you said, that you can put it in a little bit more riskier investments, but you can't do the total return in that reserve.
Right.
But you can get more out. It'd be more like a Pool A or something like that. Yeah.
Yeah, and so I really applaud your work on this. I just, as I say, the architecture on this is scary. And, it comes actually from your commentary when Senator Lummis was treasurer and would be proud, as a number of other treasurers have been over time, to talk about how much the fund has grown when effectively the legislature spends everything that is made by the efforts of the Treasury. The growth is really from the severance tax. And that's been my issue. And at some point, I would like to rethink when I made the recommendation to go to income, it was with the notion that capital gains they are not income. They are a different class of return. So what I always worry about is when we start going on about opportunity cost of return. If we went 100% private equity, we would have awesome returns, but we wouldn't have a way to spend them. So,
Yeah.
anyway, okay, thanks. Sorry, I don't mean to be preachy on this.
No, I agree with you in those regards. I think we were fortunate that 1 year we got over 23% and we were able to have some of that stick. They didn't spend it all, but that's why, and the buckets in the reserve funds that they have, the holes in them, that's, you're 100% right on that. Yep.
Well, thanks.
Thank you, Mr. Chairman. For D7, we'll pass it to Director Scoggins.
Do we need to have a motion on this, so.
Yeah.
I'm sorry. Mr. Treasurer.
So, Mr. Chairman, the motion that I would have is to amend the treasurer's recommendations to add back in our normal recommendations on spending caps that are in the statute as they are today, and to further request that we recommend to fund reserve accounts at a minimum of 5 times the spend of the spending policy, as well as an adoption of a constitutional amendment to establish a spending policy cap of no more than 5%.
Is there support for the motion?
Second.
It's been seconded by Mr. Allred, the Secretary of State. Sorry, didn't mean that. Is there further discussion?
Mr. Chairman, the way this reads, we only have a constitutional amendment for the cap. Would it be your recommendation that we actually have a constitutional amendment for the reserve fund also?
I think there's probably a lot of work that has to go into the legislative effort. I'm happy to work with you on that, Mr. Treasurer.
Okay, so you're good with the cap, but we'll work on these other
Yeah.
things. Okay, well, I think we're on the same page, Mr. Chairman.
Perfect. Mr. Representative Stith, I see your hand up again. Sorry, I keep.
No, thank you, Mr. Chairman. Question, if this motion is adopted, then it becomes a recommendation from the State Loan and Investment Board to the legislature to make statutory changes and propose a constitutional amendment as described. Is that what this motion would do?
Yes, and Representative, I cannot remember the particular piece of statute that is, but it is required of this board to make this recommendation by November 1st. So, all right. Motion's been made, seconded by the Secretary. Any further discussion? Any further discussion? Hearing none. All in favor signify by saying aye.
Aye.
Motion carries. Thank you, Mr. Keevan, Mr. Fleming, Mr. Sackett, Mr. Simpson. Good to have you here. And Director, once we get to the end of these, a matter has come up I need to attend to briefly. So if we could take a break at that point, I would imagine there may be some people who want to do that anyway. So
Certainly. Thank you, Mr. Chairman. Quickly, matter D7 is the acknowledgement of the annual ethics disclosure report. You may recall that the Master Investment Policy, Section 3, requires the members of the board, its staff, the State Treasurer's Office, members of the Treasurer's Investment Funds Committee, and the consultant responsible for investment decisions who influence investment decisions to reaffirm their understanding and compliance with the policies contained in the Master Investment Policy in the form of the annual disclosure report, which is filed with the Office of State Lands and Investments. The Office of State Lands and Investments has confirmed that those individuals noted in Board Matter D7 have duly filed an annual disclosure report with OSLI. We're recommending that formal acknowledgement be made part of the minutes of this meeting, indicating that the individuals listed in the board matter, where the table indicates they've complied, have satisfied the requirements of Section 3.4 of the Master Investment Policy. We provided an amended board matter to the board members yesterday. There is only one outstanding individual that has not complied with the policy, but we are still working on that report, and we will certainly let the board know when we have received that final ethics disclosure report.
Thank you, Madam Director. And just as a question, my suspicion is, and maybe I'm wrong about this, but the Secretary Allred may not have had the opportunity to answer this, so, or have you? Yeah, so,
Mr. Chairman, it's my understanding that the ethics disclosure annual report is back-looking as opposed to forward-looking.
I see.
And so I think there
Okay.
may have been, I think that's the reason why the one individual has not complied, because of that miscommunication. But we will work with Mr. Secretary at the appropriate time to make sure that he completes that form as well.
perfect. Thank you. Madam Auditor.
Mr. Chairman, I would move that we formally acknowledge that the receipt of this report and the indicated compliance as required.
Thank you, Madam Auditor. Is there support for the auditor's motion?
Second.
It's been seconded by the treasurer. All in favor signify by saying aye.
Aye.
All right, thank you. Mr. Treasurer, we can come back to the board. Do you think we can handle the board of deposits very quickly?
Yeah, I think.
Why don't we do that, and we'll settle this matter and then take a break.
One more. Bank put on, so.
Okay?
So, Mr. Chairman, we have a new bank coming into Wyoming, Zion's Bank Corporation, doing business as Zion's Bank. And they are eligible for as a state depository to place public funds beginning October 6, 2022, until its authority is revoked by the Board of Deposits. And so we have a recommendation that the board accept the treasurer's recommendation to approve Zion's Bank Corporation, NAD, doing business as Zion's Bank, to receive public funds on deposit effective October 6, 2022.
Thank you, Mr. Treasurer. Is there a second for the treasurer's motion?
Second.
It's been seconded by the secretary. All in favor signify by saying aye.
Aye.
The motion carries.
Mr. Chairman, Board Matter K2 is just a motion that amends the list that adds Zion Bank. So I recommend that the board accept the treasurer's recommendation of the list of eligible depositories to receive public funds on deposit.
The motion has been made. Is there support? Been seconded by the auditor. All in favor signify by saying aye.
Aye.
That motion carries. Thank you, Madam Director. We'll take, what time is it now? It is 10:34, so we take about a 15-minute break. Is that all right?
Sounds great. Thank you, Mr.
Thank you
Chairman.
very much.
Finally waking up, I changed my darn height.
5 minutes after I said we were going to reconvene, so my apologies to anybody here. I'll turn, for the purposes of the record, I think we have the same members here, the treasurer, the auditor, the secretary of state, superintendent's excused, and so I do believe we have a quorum.
Okay. Thank you, Mr. Chairman. The first item on the agenda for the State Board of Land Commissioners today is approval of the meeting minutes from the August 4th, 2022 State Board of Land Commissioners meeting.
Members of the board, you've read these and had a chance to look at them. What is your pleasure?
Mr. Chairman, I would move to approve the August 4th, 2022 State Board of Land Commissioners meeting minutes.
Thank you, Madam Auditor. Is there support for the auditor's motion?
I would second, Mr. Chairman.
Thank you, Mr. Treasurer. That second is recorded. Is there any discussion? Hearing none, all in favor signify by saying aye.
Aye.
Motion carries.
Mr. Chairman, we have provided you with the usual reports behind tab B. Again, we don't have much to add to that at this point, but we would certainly stand for any questions.
Members of the board, you've all had separate briefings and had a chance to look through these matters. Are there any questions that you have? Hearing none?
Okay. Mr. Chairman, we have provided the materials for this meeting in advance and have briefed each of you individually prior to the meeting. At this time, I'm prepared to propose a consent list if you would so desire.
Thank you, Madam Director. I believe that would be fine if you would like to propose one.
Mr. Chairman, the following items on the State Board of Land Commissioners agenda for October 6th, 2022 appear to be amenable to treatment on a consent list. C1, D1 through D19, E1 through E4, F1 through F7, G1 and G2, I1 and I2.
Members of the board, you heard the recommendation for the consent list. Item C1, D1 through D19, E1 through E4, F1 through 7, G1 through 2, and I1 and 2. What is the pleasure of the board?
Mr. Chairman, I would move a consent list as previously enumerated.
Thank you, Madam Auditor. Is there support for the auditor's motion?
Mr. Chairman,
Yes.
I'd like to pull D4 off that consent list.
Okay, D4 is taken off that consent list. Thank you. With the item D4 off the consent list, is it appropriate to move to a second?
Mr. Chairman, one more, D5 also,
And D5, all right, thank you.
and D6.
D6,
That's all.
okay, so we now have a consent list of C1, D1 through 3, D7 through D19, E1 through E4, F1 through F7, G1 and 2, I1 and 2. That is the consent list. Madam Auditor, does that seem appropriate for you?
Yep.
I'm still asking for a second.
Second.
It's been seconded by the treasurer. Thank you. All in favor signify by saying aye.
Aye.
We have a consent list. I would now entertain a motion to entertain or to confirm the director's recommendations on matters on the consent list.
So moved, Mr. Chairman.
Been moved by the auditor. Is there a second?
Second.
It's been seconded by the treasurer. All in favor signify by saying aye.
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 Motion carries.
Okay.
Madam Director.
Mr. Chairman, that brings us to policy matters. C2, consider the extension of emergency rules for the State Board of Land Commissioners Rules and Regulations, Chapter 4, Grazing and Agricultural Leasing. I would yield the floor to Deputy Director Jason Crowder.
Deputy Director.
Mr. Chairman, thank you. C2 is a request by the office for the board to extend the emergency rules related to Chapter 4, specifically for the vacant land leasing process within the grazing and agricultural leasing rules. The emergency rules were requested of the board back in June to allow the office to continue to move forward in leasing vacant lands and to work through a backlog of approximately 140 leases that have accrued over the last few years, while the board and the legislature work to better define a process for vacant land leasing, specifically defining how a preference would be applied. Mr. Chairman, we are also going to ask for adoption of regular rules in a subsequent board matter. However, these emergency rules will expire before the board may adopt those regular rules. Specifically, these emergency rules will expire on October 29th, and there's just no way for the regular rules to be initiated and effective before that date. So we're asking for an extension of the emergency rules for Chapter 4 for our office to continue leasing vacant lands and clean up the backlog as we move forward and bridge that gap between today and when the irregular rules may be in effect. Functionally, there are no changes that we are offering the board for these emergency rules. The process has worked effectively to keep our process moving forward in leasing vacant lands. And the emergency rules are a copy and follow the existing statute that the legislature passed in 2022 for a process for vacant land leasing. So with that, I'm happy to answer any questions.
Thank you, Deputy Director. Any questions?
Mr. Chairman?
Mr. Treasurer.
I guess I'd ask the question is in the area of discipline or cancellation on leases, is that's handled by policy right now, and there's no rules to basically have any guidance on that?
Mr. Chairman, Mr. Treasurer, discipline or lease cancellation are largely handled within the lease terms of each specific lease. There is one rule within the board's Chapter 4 rules that says if the lease was acquired by a fraud or deceit, the board may cancel it for those reasons. But otherwise, those are largely contained within the lease document.
Okay. All right. Thank you, Mr. Chairman.
Thank you, Mr. Treasurer. Further questions, comments? Hearing none, what's the pleasure of the board?
I would move the director's recommendation.
Director's recommendation has been moved by the auditor. Is there a second?
Second.
It's been seconded by the secretary. All in favor signify by saying aye.
Aye.
Motion carries.
Mr. Chairman, that brings us to C3, which is to consider adoption of the regular rules for Chapter 4, grazing and agricultural leasing. Again, I would yield the floor to Deputy Director Crowder.
Deputy Director.
Thank you, Mr. Chairman. The request here is that the board finally adopt changes to Chapter 4 grazing and agricultural leasing specific to vacant land leasing in Section 6 within that Chapter 4. As I mentioned earlier in the emergency rule discussion, these are changes that are copied from legislative changes the legislature made back in 2022, in the spring of 2022. There's not a lot of latitude given to the board in those statutes, and so we simply copied and pasted the provisions within that statute into the rules and have offered them for public comment and for your final adoption today. The public comment period spanned a total of 50 days. During that public comment process, we received 3 total comments related to the rule change. The first came from the Wyoming Stock Growers Association and spoke to 2 different changes in the rules separate from vacant land leasing. Specifically, it was changes to the filing period and changes to the definition of subleases. That is not sections of the rules that the board notified the public it was looking at changing, and so we didn't properly notice the public on those 2 topics. Therefore, we're not offering any changes related to those comments at this point. However, it is a good discussion to have around those 2 areas of the existing rules, and we can move forward and have a discussion with the Stock Growers Association on any enhancement we can have there and betterment of the rules. And happy to have those conversations at any time. The other 2 comments were specific to how the process was relayed in the rules and how it may be a flawed process and possibly stifle competition in vacant land leasing. Again, those aren't areas of latitude that the legislature gave the board. Again, we simply copied and pasted what was written in statute into these rules. And so any changes that those two comments would relate to would have to be legislative changes, and we'd have to work with the legislature to move forward with that. And of course, they haven't taken those up yet. So we, again, offer no changes to the rules based on those comments. Mr. Chairman, I can go through each of the changes that we are proposing to the board for final adoption if you'd like, or otherwise I'd be happy to stand for questions, noting that we did go through them at length at the June meeting, and we did work with the legislature at length as they developed these statutes as well that guided the rules.
Thank you, Deputy Director. Don't know what the pleasure of the board is on this. I think you've had a chance to read them, Mr. Secretary.
Yeah, yes, Mr. Chairman. I've read through them. I think that they're all good, and I'd like to move that we accept the recommendation.
Let me hold off on that for a moment, just so we can have some public comment. And I'll certainly recognize Edison when that's appropriate. Mr. Magagna, did you want to address the board if I don't have any other questions from the board? We have some public comment. I do see Mr. Magagna. I don't know if anyone else, and Mr. Bump, do we have people that are, okay. So Mr. Magagna.
Well, thank you, Mr. Chairman and members of the board. Appreciate this opportunity to offer our comment, and believe you've all seen the proposed changes that we've submitted for consideration, and we certainly don't disagree with the position of the office that at this point to introduce those changes in would be inappropriate. But I feel compelled to point out to you that we had actually, while we submitted formal comments during the public comment period, we submitted ours on July 26th, we had actually submitted those same comments, same substantive comments in an email to the Deputy Director on June 2nd. So it's our belief that there was plenty of time for those to be reviewed, and if the office felt that they had merit, to bring any of those that they were comfortable with into the original proposed rule. For that reason, we're very concerned that the longer this is delayed, there are just new cases coming out there. And I would emphasize, I won't go into our proposed changes at this time because they're not on the table, but I simply point out that we want to foster more responsibility on the part of landowners that are lessees to be responsible. But the current process with one notice that far earlier than when they normally receive an annual payment notice is simply not adequate to provide them or to incentivize them to exercise reasonable responsibility in making sure that their lease renewal applications are submitted. What we would ask for the board's consideration today is, given the fact that our comments had been submitted a month before the proposed rule change was even released, but that given that you are approving, I'm not sure if you just approved or will be approving the emergency extension. I believe you approved the emergency rule extension. We believe that now provides adequate time to put the rule back out with revisions, whatever revisions the office might deem appropriate based on our comments or those of others, and put those out for a second public comment period and still be able to approve a final rule before this second extension of the emergency rule expires. And we think that's a good faith approach to this that will allow us to address this issue, because if you approve the final rule today, it isn't going to make a lot of sense anytime in the short-term future to come back with a new rulemaking on Chapter 4. And by addressing those now, I think we can take care of that matter and remove Chapter 4 from needing further consideration for some time to come, hopefully. So, Mr. Chairman, with that, I'd be happy to answer any questions that board members might have.
Thank you. Are there questions for Mr. Magagna? No question.
Mr. Chairman,
Madam Auditor.
thank you for being here and for all your input. I think your request is quite reasonable. In regards to some of the grace periods, how how would you suggest, or have you had, I know you've had conversations with your members who have these concerns. There has to be a bright line somewhere. And do you have any concern, okay, well, we have a 15-day grace period, but then we're going to be fighting about the one that comes in on day 16. Do you have any thoughts or suggestions on that? And I'm not trying to be disagreeable. I'm just, I fear we're just moving the bar to a different line that then we'll try to fudge. But I
understand that, Madam Auditor. And the way I would look at that is not just taking the grace period in isolation, but taking the balance of our proposal, which says a second notice. And I think that makes a big difference in the need for a grace period. I still think it makes sense to have a short grace period, but I think if a lessee has had 2 notices and can't meet the deadline, that then we can't just keep coming back and saying, well, extend this a little further, extend this a little further. So I think that the grace period is a nice addition, but I think the second notice in a timely manner is probably the more critical thing to assure greater responsibility on the part of the lessees. I would raise another issue because I expect it will come up. The change in the notice periods, I think, can easily be done in Chapter 4. There may be some pushback that creating a grace period goes beyond the statutory authority. And we have taken this to the Joint Ag Committee, and they in fact have some legislation being drafted that will address whatever part of this you may not be able to address through the rulemaking process, but certainly to the extent it can be done through rulemaking, that would be our preference.
Thank you. Mr. Treasurer.
Yeah, and thank you, Mr. McGagna. I like your recommendations and all of them, but I do want to talk a little bit about this subsection B here, the grazing of livestock that are not owned by a leasee. And I think that goes into a situation where, you know, there's if you're an individual and you have somebody come in, but if you're an LLC and somebody's part of the LLC, minority shareholder or something like that, or co-op or something, some other structure, there's no question that that's allowed. But you know, I guess if you're just an individual, this kind of gives you a little bit of room to manage your farm and ranch by taking in extra cattle in a good grazing year, and I think that's appropriate. The question I've got is I'm trying to figure out a way in areas where maybe somebody makes a mistake, but they remedied that mistake, and that mistake could basically be something that could have a disciplinary or a cancellation of the lease. And the problem that we have now, I think, is that there's different rights that can be taken away from a person as far as preference without necessarily that land becoming vacant land. And so I'm thinking of a way we could handle that is to say that if somebody is disciplined, that the Office of State Lands shall cancel that lease no later than 1 day prior to the issuance of the new application for that lease. In that way, that would make that land vacant land because there'd be no current leaseholder there when it was actually leased. And I think we can do that by policy. And I didn't know whether or not, could you give that some thought if you have an idea now, whether that might help some existing, you know, rancher stay in business and keep that integral part of their ranch, because a lot of times that state lease, without it, the value of their whole property is diminished. And so you lose more than just the ability to lease or to run cattle. You actually diminish, you know, you have a property loss there, and you have no really recourse in that. And so I'm just wondering what your thoughts are.
Mr. Chairman, Treasurer Meyer, I guess in my thought process, I kind of separate that from the grazing unowned livestock, because I think the grazing unowned livestock is, our view is, as long as you are the party responsible for the livestock when they're on the state land and everything what brands on the livestock or who actually owns them should be immaterial, as long as you're managing them properly and grazing the land properly. And that's what we attempt to address there. And that comes up in the scenario you indicated where people maybe sold off cattle because of the drought last year. And next year they have a better year and you can't replenish your herd in 1 year, but you can bring in some additional livestock. Or more and more, we're seeing people who've gone to yearling operations. They may own those yearlings, but they may bring in yearlings. And as I've told some others, I think if you did a thorough investigation today, I would not be surprised if 25% of the state leases out there are in violation of that provision, to be honest. And I've talked to ranchers and asked them about that. They said, oh, we didn't know that we couldn't bring somebody else's livestock in. So, but now setting that aside and addressing your other issue, I guess the way I have always seen a violation of a term of a lease is that if that is uncovered and the office can bring a recommendation to this board, that this board has the power to cancel that lease at any time. I don't think you have to wait till a day before it's due or anything else. But I think, a violation and what the penalty to a violation is, if I'm not mistaken, there's flexibility right now. The office could recommend the lease be canceled. Office could simply recommend that certain stipulations be put on that lease to assure full compliance. I think there's a range of alternatives that, in my view, don't need to be spelled out in regulation, but exist within the powers that the board currently holds.
Okay. Yeah, Mr. Chairman, I was just trying to maybe get in the interim type of a thing, a policy that we could maybe recommend to those 25% of the operators around Wyoming, if they get caught in that catch-22 thing, that rather than going to a situation that occurs sometimes where you lose the preference right in renewal of a lease, that you could turn it into a vacant land renewal.
Mr. Chairman and Treasurer Meyer, I guess that really comes down to, under the current scenario, is to how you interpret the language, the statutory language that says a sublease, any other agreement regarding the land. And the interpretation that we would give to it is that simply bringing in unknown livestock and agreeing to manage, for me, agreeing to manage some of your livestock is not an agreement related to the land. Changing who manages the land, if I'm going to turn it over to you, then that is an agreement, or changing how it's going to be used. But simply agreeing to other livestock is not, in our interpretation of the statute, is not an agreement relative to the land. It's totally separate from that.
Okay, thank you, Mr. Chairman.
Thank you, Mr. Treasurer. Auditor.
Mr. Chairman, emergency rules can be extended twice or just once?
Mr. Chairman, Madam Auditor, twice. This would be our second time. They would be good for 120 days. So that would get us into February, I believe.
So, Mr. Chairman, just to follow up for Mr. McGagnet, what is preferable to, I'm looking for a clean way to ask this. If we pass new rules in February, that doesn't seem to make a load of sense to me if we know it's highly likely, and I think it is highly likely, we'll have statutory changes coming as well. And so would it be better to, and again, I'm just saying this bluntly, is it better to sort of delay the whole mess until after the session ends so we're not changing rules 17 times versus passing final rules in February and then having to start over again when the session ends?
Mr. Chairman and Auditor Racines, I guess looking at the whole picture, in either case, whether you pass a final rule in February or pass a final rule today, you're looking at starting over if the legislature makes changes. The advantage, from my perspective, in incorporating some of these changes or considering them before adopting a final rule is that there may be some of these matters that you can address through rulemaking that then we can encourage the legislature not to incorporate in whatever changes they make. So that we don't have the legislature, frankly, taking over some issues that can, in our view, better be handled by this board.
Madam Auditor and Mr. McGagna, I'm very much in support of that notion. There's a wonderful book written several years ago called The Death of Common Sense, in which it talks about how most people understand the Constitution. It's elegant, it's pretty clear. But when we talk about what the statutory requirements for refining are concerned, it's, pages and pages, and look at the ACA. And I think when we try to solve things at the legislative level, we've had recent experience about that. It doesn't always turn out as we had hoped.
That's certainly true. I'll be honest, Mr. Chairman, I might take the opposite view if we're talking about the federal level. But that's certainly my view with regards to the state.
Yeah.
Mr. Chairman, if I could.
Madam Director, please.
I would disagree with Mr. McGagna with respect to what the legislature's up to. From our understanding with Joint Ag, they are considering an automatic renewal process for grazing leases, as well as an extension or a grace period, if you will, trying to decide which way to go. Either one of those would require us to reopen the rules again to address them. So I guess if you're asking for staff input, I think it would be our position that we would rather the board go ahead and adopt the regular rules today. You can direct us to continue to work with Mr. McGagna through the holidays and into the session, and then revisit this, as I anticipate that we will have to reopen these again after the legislative session. Not to mention the fact that we're down 30% staffing in these key areas to address some of these things. And so that's going to impact our ability to solicit comment and all the other things, and to keep sort of kicking the rulemaking process down the road and reopening. So that would be our preference, Mr. Chairman.
I appreciate that, Madam Director. And, I think the one thing that would augur in favor of this, if there are statutory changes, it would require reopening rules. Those would take a particular period of time to be done. We would have a set of rules, and I guess I'm looking to Mr. Peters or Mr. Miller to sort of tell me if passage of these rules would provide us the grace to be able to consider the statutory changes, which will no doubt probably come at the end of March or in the middle of March, somewhere in that period of time, and not have to go through another round of emergency rules and so on and so forth.
Mr. Chairman, Jim Peters, the Attorney General's office. I think part of that does depend on what the legislation looks like, assuming that it does go through. I mean, I think it certainly may require, even if the board were to adopt rules today or later on in the year, as Mr. McGagna has proposed, I think if there is new legislation that moves forward, as Director Scoggin mentioned, I think the board may have to undertake the rulemaking process again, regardless of how it.
Mr. Peters, let me put a finer point on it. If there are statutory changes, most likely they would take place at the beginning of July. And so we would be covered with rules and have the opportunity to develop a set of rules that were necessary, unless the legislature made them effective immediately, which I would suggest is not necessarily the best approach. But I'm just asking if this would cover this in that interim.
Mr. Chairman, this would cover the interim until the new legislation became effective, correct?
Okay, thank you. Yes, Mr. Secretary.
Thank you, Mr. Chairman. While I appreciate the director's comments about the timing and things like that. I do believe that there is a couple of these in Mr. McGagna's comments here that are really valuable. And I think that it might be, we have the time with them. We've passed the emergency rules already, so we're there. And I think maybe that we do go ahead and open it back up for public comment and possibly bring these in. We don't know what the legislature's going to do. And of course, you always have the chance to knock out anything that they do. So, and as you mentioned, that goes till July. So I think that it might be worthwhile. And I'm sorry to the director. I know the staffing is a problem, but to go ahead and open these back up and possibly consider these before we accept the regular rules. Thank you.
Okay.
Mr. Chairman, I have one more question
Madam
for Mr.
Auditor.
McGagna. Is it a concern, and again, predicting things that may or may not happen, if we were to pass regular rules in February and those did include some sort of grace period or a second notice, my one thought and or concern is we're smack dab in the middle of due dates for things, are we not? Aren't those January, February, and March 1st? So is there, I guess my concern is I feel like that year's worth of applicants should sort of be treated uniformly, or else we're creating the haves and have-nots to some extent. Is that a concern, or is that something you've given thought to? It would just be very confusing if, okay, well, if your lease was due on March 1st of this year, you get the week-long grace period. If it was February 1st, you're a have-not.
Mr. Chairman and Auditor Racines, that's a very worthwhile thought. I guess what I'm thinking of, if you look at the process that the office follows, and I had just the opposite concern first, I'll express that if you wait for the legislature and rules become, or the statutory change become effective July 1st, then by the time you go through rulemaking, we're looking at another complete cycle of lease renewals under the current rule, with the inevitability that we're going to end up with an additional stack of so-called vacant leases because of the characteristic of the current rule. Where if we did something now or in February, it would assure that when the office starts the renewal process in August, that they would be doing it under at least the changes that you have made. It wouldn't be yet under any legislative change. It would be under the changes that you as a board have made. As far as a change in February, I'm trying to do some quick math. We're in October, so you would have to do this by what, February 10th or something, 120 days, whatever that comes to. I would think it could be looked at. Now, the grace period may still apply, but the notice periods, we would already move past that period as far as the notices.
Thank you, Mr. Chairman.
And I don't know whether what your discretion as a board might be to say this certain provision will become effective at a later date. I don't know if you have that discrepancy or not, but.
Mr. Treasurer.
Just a quick question, I guess, as to whether or not, and I guess this is to the AG's representative, as to whether or not, so you're listening, so whether or not any of these suggestions, which I think have fairly universal support on their face from the board, whether or not they're applicable to the statutes. And so, because I think that if they're applicable to the statutes, that's an easy deal for us.
Mr. Chairman, Mr. Treasurer, if I'm understanding your question correctly, it's whether the proposed amendments from the Stockgrowers Association would be consistent with the statutes or are authorized by the statutes. As it relates to the additional notice requirements, there's nothing contrary to the statute there. That would just be imposing an additional requirement on the Office of State Lands and Investment staff. For the second proposal about for renewal applications received not more than 15 days following the expiration date. The statute sets out that time frame for filing renewal applications. So it would be our position that this would not be in alignment with the statutory timeframes. For the third portion, the sublease piece, the statute does say, the language in the statute is contract all or any part of the lease area. So there's a question of whether this sort of arrangement is a contract of all or any part of the lease area. That is subject to a little bit of discretion on how the board interprets that statute. So I guess at this point, I'm not prepared to say it's contrary to the statute, but I think it would be a close call. I think the board would be interpreting whether this sort of arrangement would be a contract for all or part of the lease area or not. So it perhaps could be something that the board may be able to entertain as consistent with the statute, but again, it's not perfectly clear whether.
And then not less than 30 days to match a competitive bid.
Mr. Chairman, Mr. Treasurer, as I understand that provision, that would just be the requirement to provide the notice.
So that's fine.
Within that period of time, I believe that would be okay.
Mr. Chairman, I know in a lot of different areas that management, as far as taxes, you can't tax management. That's been determined. I know that in areas where somebody buys a insurance for any reason, and there's a situation that somebody can't rely on the proceeds of that insurance to limit the liability that they may inflict upon the person who bought the insurance, because that was a management decision. So I think that management has a fairly broad, effect of allowing a lot of different things to where that it doesn't apply, or basically keeps some things from applying in certain circumstances. So I think it's, from my perspective, it's at least a 75% chance that this is what they propose is something that's going to stick. So I think that's definitely a lean yes on that from my perspective, from that thing. So I guess if we did pass these things, with the exception of that the number 2 one that you said was a no, we'd have to, the process would be to lay this on the table until a future date and go through the notifications and things. And can all that be done how long would that process actually take in days?
Mr. Chairman, Mr. Treasurer, if the board was inclined to re-put these out for public comment with some of the additional proposed changes, that would essentially restart the public comment period. So we would have a minimum of 45 days for public comment from the date that it's put out, or that solicitation is notified. Then it would need to come to the board for approval. Perhaps that could be as, again, assuming public comment was put out in the next week or so, that perhaps could be completed and brought to the board by the December meeting. And then after the board would move for final adoption of rules, there'd be an additional 75-day time frame in which all of the necessary reviews could be conducted. And they would need to be signed and filed within that 75-day period. So that would take us to February of 2023 by the time that the rules actually may become effective.
Now you're right at that Yeah, you're right at that 120 days just with those things before we actually get to, before they're actually, so it would be real tight on the emergency rules.
Mr. Chairman, Mr. Treasurer, the emergency rules actually will be, the 120 days won't start from today.
Okay.
They will start from the date that they are signed and filed. So today was the readoption of the emergency rules. What will need to happen next is there will be a packet that's put together, submitted. It comes to the Attorney General's office for review, provide our advice to the Governor's office, and then once those rules are signed by the Governor's office and then filed with the Secretary of State's office, that's when that additional 120-day window begins. So that may be another week or 2 weeks out still.
So do we, excuse me, Mr. Chairman. So do we have, I guess, emergency rules that are effective till when?
Mr. Chairman, Mr. Treasurer, the current emergency rules are effective until October 29th.
Okay, so we'd have till October 29th to walk it across, and that would give us the longest time period that we would have, and we'd be able to do it within that 120 days from today, or within that time period. So it is doable logistically. That's what I wanted to find out.
Mr. Chairman, Mr. Treasurer, correct.
Thank you. Madam Auditor.
And Mr. Chairman, we could extend, if it was a matter of, I mean, we can extend the emergency rules one more time if it was
No, we
required?
cannot.
Oh, we're
This
already,
is our second. Yeah.
okay. I'm glad I asked. Okay.
Thank you,
Thank you,
Madam.
Mr. Chairman.
Mr. Magagna, I had a question. I just wanted you to explain I certainly understand the recommendation of the insertion of the grazing livestock that are not owned by the lessee shall not be deemed to be a sublease contract or agreement controlling the lease premises as defined in Section A, so long as the lessee retains full management authority and responsibility of livestock while they're on the lease parcel. I just wanted to, I think last time I talked about, relatives, kids of folks that may have their own brand and technically that livestock and nobody's going to charge that. In a really tough drought year, we all know grass can be incredibly valuable and much, much, much more valuable than what the state would require. Your language here is not intended to sort of defeat the process of saying that the state gets a portion of whatever that differential between the base lease and the opportunity, for lack of a better phrase, lease would be.
Mr. Chairman, I believe if you were to adopt that language, that would, just bringing in other people's livestock would not per se fall under that provision, is the way I would read it. And I've visited with quite a diverse number of ranchers about this. And just to oversimplify it, I guess, the issue that comes up, if I put a cow out on a piece of land and make $5, what is the difference whether I made that $5 off the cow I owned or off the cow that I brought in to graze? I mean,
No, I understand that, but if I'm out of grass and I go to you and I say, I'm willing to pay you $65 an animal unit, would you say, no, I'm only going to take the 5? Or would you say, I'm happy to take the 65?
I think what complicates that, Mr. Chairman, and we had one of our members testify before the Joint Ag Committee on this issue. What I take for taking care of that cow has a lot of factors in it. I'm providing management. This particular rancher testified, I put out the salt. He happens to be a retired veterinarian, so he provides veterinary services as part of whatever price he agrees to. And he said, I sit down and in my mind, it takes me days to come up with a number for the state land office that I think I can defend, because there's so much complexity to it. And if state lands are being leased for the value of that grass, then the value of that grass doesn't change by whose cow consumes the grass, is what I'm trying to say. And I realize the argument about maximizing revenues and everything. I think there's other ways to get there, but I tend to think that way that we currently have is not an equitable way and not an easy, feasible way to administer in a meaningful way.
Would that same logic then apply to mineral development? So in other words, I guess what I'm saying is you have adjacent lessees that are getting quite a bit more for their mineral being developed, and we're selling underneath it. So the differential shouldn't mean any difference on that.
I think that's significantly different simply because you have a specific lease for development of those minerals as opposed to a long-term grazing lease that is a lease to harvest forage. And there are so many, if you want to call it, games that can be played. I'm familiar with a lot of arrangements where people do 2 leases and say, I'll agree to bring your animals in and I'll charge you $5.89 or whatever the current state lease is, not only on the state lands, but because how much time do those cattle spend on that piece of state land versus my private land versus my BLM land? I'll charge you that across the board, but then we're going to have a separate agreement that's a management agreement, and you're going to pay me X number of dollars to provide management. So it's not the right way to get where we're all hoping to be, I think, and I'm not sure I have the answer to a better way to get there. But
yeah, okay. Yeah, I'm just trying to figure out how to do that because you know as well as I do that markets vary dramatically from year to year.
Sure.
And the state really can't participate
and
that.
Ideally, but I'm not going to argue that it always does, but the formula that we adopted back in 2011 or that to determine the grazing fee on state lands, it's supposed to be reflective of those market conditions. Those are the factors that are in it. Now,
right.
You can debate all day whether it's appropriately reflective or not. But
Sure. Okay, thank you.
I might just mention, if I might, Mr. Chairman, one more thing with regards to the discussion on the grace period. I'm certainly in agreement. In fact, I believe in some of my early discussions or correspondence with the Office of State Lands, I acknowledge that particular provision might be one that needs legislative action, and we're certainly respectful of that.
Okay. I'm going to recognize the Secretary and then you, Madam Auditor.
Thank you, Mr. Chairman. Mr. Magagna, question that I have on here where you have a change not less than 30 days to match the competitive bid. Both the statute and the current rules apply 30 days from the notice for them to file the renewal matching that bid. So under the statute, it says the bid has to be, they have a preferred right to renew the lease by meeting the highest bid offered by another qualified applicant. So if somebody does have that's already there. So I'm just wondering what is it you want to change with this? Because the statute and the current rules already give that 30 days from the receipt of notification.
Mr. Chairman and Mr. Secretary of State, I believe, and I don't have all my notes in front of me right now, what I was attempting to address that under the new rules that are the result of legislative action last year, there can be multiple processes involved in competitive bids. It's not just a one-time process. If there's 2 parties that have a preference based on contiguous lands or adjacent lands, then there can be a second bid process and a final bid. And it was simply an attempt to assure that in all those cases, you would have that opportunity. And perhaps the current language does that. I'd be happy to go back and look at it. I can't say for sure as I stand here right now.
Thank you.
Thanks. Madam Auditor.
So, Mr. Chairman, let me just say this out loud. Mr. Magagna, the desire to perhaps open this back up for comment, the real features of that are the subleasing issue and additional notice. That's it, correct?
That's correct,
Okay,
ma'am.
thank you. Yeah, I just want to make clear that,
Yeah, those are the 2 things that we feel are causing problems today that need to be addressed. The grace period is certainly open for additional discussion, both here and with the legislature, and we would respect whatever the outcome is on that when that discussion takes place.
Thank you, Mr. Chairman.
All right, further discussion? Further discussion? Mr.
you,
Secretary, did you want to make, Mr. McGagnon, thank you. Did you want to make your motion or?
Mr. Chairman, I think I'll hold off, see what the
Okay.
others think.
All right,
Yeah. Mr. Chairman,
Mr. Treasurer.
I would move that we would table this and take it back up at the December meeting.
Okay, that motion has been made and has no discussion to it. It has been moved to table it. Is there a second? Is there a second? Is there a second? Motion fails for lack of a second. Next. Madam Auditor.
Mr. Chairman, I would move that we instruct OSLI to open this section back up for public comment and to work with stock growers on the suggested changes, primarily being the subleasing issue and the additional notice issue. I think we are all in agreement that we do not have the authority to add a grace period. That is contrary to the law. We can address that after the legislature acts or doesn't act. Mr. Chairman, I think that would be my motion.
Okay, that motion, you've heard it from the auditor. Is there a second for that?
I'll second.
It's been seconded by the secretary. Is there any discussion?
Mr. Chairman, if I may.
Mr. Peters.
Mr. Chairman, Madam Auditor, I guess to reinitiate the public comment period, was it your intent that there are specific provisions within the Stock Growers Association comments that public comment period be reinitiated with? I just want to make sure that the board understands exactly what set of rules are going to move forward with the public comment period.
Mr. Chairman, yes, that would be my intent, and I apologize because I don't know what sections to reference, but the two that I think need
Section 10.
to be featured are the adding of an additional notice, or that just notice requirements, and then the issue of grazing livestock that are not owned by the lessee being not determined as a sublease. Is that sufficient?
Mr. Chairman, Madam Auditor, I think that is sufficient, just to make sure that I'm understanding everything. The motion, and if it wasn't as clearly stated, is to authorize the Office of State Lands and Investments to move forward or initiate the public comment period with those amendments to the proposed rules.
Yes, Mr. Chairman, that is my, just as he stated, that's my motion.
Okay, thank you. And the second accepts that as well?
Yes, Mr. Chairman, I do agree. Looking at the statute, we do not have the authority to extend the grace period, so that shouldn't be part of it.
All right, further discussion, further discussion, further discussion. Hearing none, all in favor signify by saying aye.
Aye.
That motion carries.
One issue that I'd like to get some clarification on, and maybe we'll need to have some clearer policies, that Mr. McGagnon did say that he communicated, I think, with staff, but maybe it wasn't done in a way that you expected comments to come. And I don't know if there's a specific, methodology that where you accept comments, but if you're at Subway and you're both getting a sandwich and you comment on something necessarily, that's not right. An email doesn't sound like that got the attention to actually get in the official comments. So is there an official way for comments to be received?
Mr. Chairman, Mr. Treasurer, I believe the rulemaking statutes has a specific procedure wherein somebody could request rulemaking on different aspects of the rule. Perhaps Mr. Peters could take it from here.
Mr. Chairman, Mr. Treasurer, Director Scoggin is exactly correct. There is a provision in the Wyoming Administrative Procedures Act that allows interested persons to petition for rulemaking. It doesn't actually describe exactly what that petition needs to be. But it sounds like in the case of this specific scenario, the proposed rules, as I understand them, were presented to the board on June 2nd. And it sounds like at that same time, perhaps at June 2nd, there were some additional suggestions or proposed amendments that were requested by the Stock Growers Association for the board to consider. And at that time, the board had moved forward with the proposed rules as were recommended by the office. So during that period of time, it generally petitions for rulemaking, they can come at any time. It's probably largely contemplated that they come, when there isn't proposed rulemaking on the table, but there's no restriction in the Administrative Procedure Act on when those petitions can be initiated. And I apologize, one last follow-up. And I think that is also, what was occurring here is that kind of due to the timing, it wasn't making those changes to the final rules today would not have been a logical outgrowth. So it couldn't have been something that could have been considered now unless the board, one, went back to the public comment period, which it just chose to do and initiate that process, or two, as the office had recommended, consider that petition following final adoption of the current rule. So I think those were sort of the two options that were at table, and I think both do comply with the Administrative Procedure Act on considering those petitions for rulemaking.
Okay, thank you.
Thank you. And just one final thought. We've been in rulemaking on this for a long, long time. But as a comment to your comment, Mr. Magagna, I was just sitting here reflecting in my mind, have we opened a can of worms potentially with this grazing of livestock not being considered a sublease? Because if I own a horse and therefore have actual and necessary use of vacant land, get to and acquire that lease and then turn it over and start, my management routine, which is substantially above whatever the particular state grazing rate is. Am I opening a can of worms, because I am showing actual and necessary use of the land, but I am then turning it over just to making bank at the expense of the state. So I want to think about how we, if that makes sense to you.
I understand your point. I'm happy to have further discussion on that.
Okay, thank you. Madam Director, thank you for your patience on this and
Well, Mr. Chairman, if I might just respond to the treasurer as well with his last comment. I just want to make it clear that we were not ignoring the stock growers' comments in any way, shape, or form. The timing, timing is everything, right? And when we received that letter, as Mr. Peters mentioned, we were in the throes of getting the rulemaking started so we could even get the vacant leasing statutory requirements codified in the rules. And when we received Mr. Magagna's letter, a lot of the issues pointed out in that letter did not seem germane to that issue. Plus, we were in discussions with Joint Ag about these other aspects of the rules, such as the potential automatic renewal, the grace periods, all these other things. And we thought that the issues raised by Mr. Magagna, while interesting, required a little more discussion and understanding so that we could better formulate our views in light of longstanding policies and procedures, and it just wasn't going to sort of make it into this rulemaking process. So we were not meaning to disrespect Mr. Magagna and stock growers, just the timing wasn't correct.
Thank you. All right. Thanks. Thank you all for that. I think we're moving on to,
Yes,
if
Mr.
I'm looking
Chairman.
matter, D4.
D4, Mr. Chairman. So, Mr. Chairman, D4 is to consider the request to approve the Conservation Reserve Program Grasslands Contract Lease Number 1-7109, John R. Newell, Goshen County, Wyoming. And the Mr. Secretary asked that we pull that off the consent agenda.
Thank you. Mr. Secretary.
Thank you, Mr. Chairman. And these comments go to the other ones that I pulled off that are all basically the same, dealing with these conservation easements, as you would. You know, I've got real concern with these. This basically is taking our state land and allowing somebody else to put an easement on that. And these conservation easements, they, you know, they have the capability of, you know, dictating how things are done on that property. And I think that's more the state's place to handle that with our land. To allow somebody to benefit from putting a conservation easement on our state land, and I have a problem with them committing our property under their deal. There's a benefit to them. Usually it's a monetary. And so basically he's making money off of our land. And I know with that, part of that comes back to the state. But the biggest problem that I have is that allows these groups that do these conservation easements, generally, when you sign those in, that conservation easement takes first position on the property. And that's usually part of that easement. And even still, to allow them to dictate what happens on our property, I have a big problem with that. And so I would recommend that we do not approve these easements.
Thank you, Mr. Secretary. Just for point of clarification, Deputy Director, this is a conservation reserve program, which is a different animal than conservation easements, if I'm thinking of it correctly.
Absolutely, Mr. Chairman. It's a specific provision within the U.S. Farm Bill that allows this type of conservation practice to be allowed on the ground. It's not a permanent situation. It's not a perpetual easement. It's a termed contract, typically for anywhere from 5 to 10 years. It does dictate management on that property as far as what can be done and what can't be done. Obviously, it's a program that's intended to protect arid lands from further, I've lost the word that I'm looking for, loss of soil, erosion, getting those marginally productive lands out of cultivation or some type of row crop situation where the soil may be degraded over time. It's not the best acre to have that type of practice on. So the Farm Bill contemplates removing that acre from production and compensating the landowner for that conservation, if you will. The board has approved contracts like this in the past. Again, they're for 10-year terms, and it shares in the payment that the lessee would receive. And I'm going back to the regular Conservation Reserve Program, the CRP type contracts, where in the first...
And that's what these are, is that correct?
Well, these are a little different than the regular CRP contracts. And I'll make a distinction here. In the regular CRP contracts, the first 10 years, that applicant or our lessee is expected to have inputs into that land that may cost him money. Seeding from a row crop situation or dryland crop situation into a native grass situation, possibly some shelter belts to protect or enhance wildlife presence on the area, and maybe some soil mitigation measures as well. Fencing could be a cost. So the board, I don't remember the exact year, but probably 2009, 2007 era, approved a policy where it would share in 25% of the payments received from the Farm Bill for the CRP contract that went to that 8% because it's expected that all of the inputs expected of that applicant had already happened. They were just receiving money at that time. So we would be sharing 50% in those. And again, both of the contract 25% and the 50% share is well above any AUM we would receive off of that property. So it made good fiduciary sense to enter into those. How this contract is different is that the Farm Bill created another subsection underneath the Conservation Reserve Program that tried to enhance and help people who were simply grazing land and not farming land, to put them into more of a don't graze every ounce of forage out there, but enroll or have us approve a grazing management plan for you. And if you graze in a certain way, we will compensate you to do that because you're probably not putting as many animals out on the property as you were originally. And it's intended to help the health of the rangelands across the West, survive drought impacts, survive weed impacts, things like that. So this specific subset of that CRP contract is simply helping those grazers manage their grazing practices in a responsible and sustainable way. When we reviewed the contract, there weren't any other cattle coming onto the property other than what were owned by that particular lessee. So we felt like it met the spirit of the statute and the rule, everything that we just talked about, that the lessee that we or you have leased to is running their livestock on there. However, the federal government has come in and said, now we will help you manage how you're doing it. So we're asking the board to approve the contract because that's required in statute and rule that the board must approve any contract related to the land. But we don't feel the board is entitled to sharing in the payments that would be received because it's a grazing management practice. It's not a setting aside for a different type of use like the other CRP contracts.
So to be clear then, the land is being used. Most of these, it looked to me, were like renewing expiring CRP contracts. So there's an existing landowner on the property and they're being rewarded for doing grazing practices that they initiated. Is that probably correct? But to the Secretary's good point, within the constraints now of the federal government.
And Mr. Chairman, when we looked at this, there are a lot of constraints a lessee can be under. We don't provide specific grazing management practices that they must abide by. We give them a general AUM amount that they can use throughout the year, but we don't explicitly tell them when to or by what class of livestock to do that. So they can get monetary benefit from a variety of different sources to adjust their grazing management practices. And that's not anything the board has ever dictated in the past. So this didn't seem outside of that.
And if the contracts weren't approved, they would just be subject to the normal grazing practice. And then,
Mr. Chairman, if the contracts weren't approved, then they wouldn't have the ability to contract with the FSA. To do this, and they would be out that contract on the state acres that were involved.
And do we know if that's part of their perhaps mortgage or operational loan or other aspects of that?
Mr. Chairman, I'm not aware what these specifically.
Okay, thanks. Madam Auditor.
Mr. Chairman, what happens to the CRP grasslands agreement if the applicant were to lose the state lease?
Mr. Chairman, that's a great question because it happens in the normal CRP contracts as well. If we were to, the board issues an oil and gas lease and that oil and gas lease reaches development and they put a rig on there, the lessee is expected to pay back all of the payments related to those acres that the pad impacted. The same would be here. If for whatever reason they lost the lease and they couldn't perform to the performance measures of the contract, they would have to pay back any funds that were received by the FSA. From the FSA.
Okay. And Mr. Chairman, and this may not be appropriate, but I'm wondering if Mr. McGagnon might have any input on this program or have heard from his members on its. To me, it seems like something that could be a benefit to our small producers to kind of offer them some expertise and or guidance that they may not have, but I don't want to misinterpret that. And if he doesn't want to comment, that's fine. I'm just wondering if maybe he would like to.
Thank you, Mr. Chairman. And this is a program, it's a relatively new program among all the USDA programs. It has garnered some popularity among our members, particularly along the eastern tier of the state, which is where most of these grasslands reside. And the thing that we tend to like about it, and I believe you mentioned that, Governor, is that it's not mandating that you necessarily do something different. It's recognizing that you have practices in how you use the land that provide these conservation benefits, and you're being rewarded for it. And two things. One, I think it fits in with state lands because state lands doesn't do that. You have to not abuse the land, but you use it however you want. And this is a way that to entice the landowner to do, not the landowner, excuse me, the lessee, to do some things that will actually benefit the state land over time. The other thing I would point out is that often these are done, not isolated on a piece of state land, but on a larger operation of private lands that has intermingled state lands. And I don't know the answer to this, but I would seriously question in my mind whether a landowner would necessarily be able to do it on their private land if they couldn't incorporate those integrated state parcels into the agreement. So clearly it's a choice for a landowner. We don't tell anyone you ought to do any of these federal contracts, but we think this is one that doesn't have negatives to it for those who choose to utilize it.
Okay, thanks. Thank you. Mr. Secretary.
Just to be clear, you mentioned that the state does not get any of this money.
Mr. Chairman, on these three specific, or not just these three, but any grassland type contracts, we're not sharing in the funds that are received by the lessee.
Okay. Follow up, Mr. Chairman. I still, as I look at this, I still express my concern that on our state land that we're allowing somebody else to dictate what happens on there. And we're not getting any benefit off of it. I believe that we should be the ones, not the federal government, telling our lessees what they can and cannot do with that land. And whether we do at this time or whether we don't, as you say, we say how much AUM they can have on there. I think that's one way of, whatever that lease is for, that we can regulate some of that grazing on there. I just hesitate to give any more control with federal government of our state land than they already have.
Well stated. Yeah, Mr. Treasurer, and just as a point of information,
Okay.
Just before that, they still pay a grazing lease to retain the land. Is that correct?
Mr. Chairman, that's correct.
Okay, thanks. Yeah, Mr. Treasurer.
Yeah, now, in most of these areas, if I recall, that the original use of the land was cropland. And that's why the first 10 years you take it at 25% of that payment.
Mr. Chairman, that's correct on the regular CRP program. This is separate. It's just a grassland program, so they possibly were farmed way back in the past, but not in the immediate past before this contract.
So this isn't land that was CRP in the first contract and then changed to CRP in the second rendition of the federal program.
Mr. Chairman, Mr. Treasurer, I don't believe so. It could if the native grass is held and it was totally converted from farming back to native range. I suppose there could be a chance that this could be a subset or a secondary contract related to that. But I think we need more years, more decades to pass before that would actually occur. So I don't believe these are that way, but I couldn't tell you for sure.
I remember the CRP program, Mr. Chairman, clear back in, I think, the 70s. I know in the 80s. Yeah, if it's CRP ground that was farm ground and then continues to be farm ground and moved into that, they're probably still getting a very substantial $30 an acre or something like that for basically grassland to keep it grassland. So that's. Yeah, they're getting a really good deal if they're only paying $5.91 or whatever now. Okay, Thank you, Mr. Chairman.
And
Thank you.
Mr. Chairman, in that example, we would be sharing in the $30 per acre as well. If it was still under the original CRP contract, we would share in that payment.
Okay, further comments? I think you've heard the Secretary's comments on this. What is the pleasure of the board? Mr. Secretary, would you like to make a motion, or what would you?
Thank you, Mr. Chairman. I would make a motion that with all those that I pulled off on the consent list, that we vote those down.
Okay, so your motion would be that D4, D5, and D6 be voted down.
Yes, sir.
Okay, that is the motion put forward by the Secretary. Is there a second? Is there a second? Is there a second? Motion fails for lack of a second. I'd entertain another motion.
Mr. Chairman, I would make a
Madam Auditor.
motion to approve the director's recommendation. May I do it on all three, or do you prefer
In the efficiency of time.
on D4, D5, and D6? And I think the secretary made some, well, you know what, I'll wait for a second and then I'll have
Okay.
discussion.
So you've heard the auditor's motion to approve the director's recommendations on D4, 5, and 6. Is there a second?
Mr. Chairman, I would second that, but I want to know a lot more about how these things are, because I really feel if it was a piece of farm ground and it went to grass, and they're getting roughly the same amount of money that they did when they went to the grass, then I think usually there's about a 20% reduction because it's already established. But yeah, it just seems like you're taking farm ground out, which the problem I have with that, Mr. Chairman, is that you get less people going in and buying fertilizer, buying tractors, buying equipment, and so you have a diminishing return in another return stream when you essentially take it out of the capital intensive farming structure and put it into a ranching structure that doesn't have the same tax benefits. And so the reason that you usually get that same percentage in the first 10 years is to essentially that kind of offsets that diminishing return that you get from all other revenue streams. So if we take something that's getting $30 an acre and we go down to something that's maybe getting $6 an acre, that's a fairly substantial hit right across the board. But I think not allowing these isn't going to put it back into farm ground. It's just going to mess up some operations that are really depending on this process. And to the extent of regulations, the FSA program, it gets into every area of agriculture, and until that changes, that's something that just doesn't make a dent in the regulations.
Thank you, Mr. Treasurer. Madam Auditor.
Mr. Chairman, I would just note, these are all current grazing leases. They're ranchers now, and I'm very hesitant to take away as much stress as our small producers are under right now. And as you mentioned, needing to pay bills and facing the drought, this may not be a tool we love, but I'm highly hesitant to take away tools that our small producers have to use. And they probably don't like them either, but they're what presented, it's what they have available. And so I'm hesitant to take away their ability to pay their bills and keep their operations going at this time. So that's why I made the affirmative motion.
Thank you. Further discussion? Further discussion? Further discussion? All in favor signify by voting aye.
Aye.
Nays?
Nay.
That motion carries. Thank you.
Thank you, Mr. Chairman. The final item on the agenda today is the Forestry and Fire Report from State Forester Bill Crapser.
So,
Good afternoon, board members, Mr. Chairman.
I was trying to get you to morning, I'm sorry.
First off, all predictions were that this was going to be a really, really bad fire season. We had enough rain during the summer, and we had enough good firefighting capabilities and enough luck that it wasn't a terrible summer. It was probably what we'd call an average summer. Our emergency fire suppression account, we had 7 EFSA fires statewide, committed about $5 million to those fires. That's a little bit higher for the number of fires than normal. Part of that is the fish fire up in the Black Hills was well over half private land. So it was charged to the county and to us instead of the Forest Service. Our single engine air tankers this year flew on 30 fires and were very, very effective, once again, keeping fires small and effective at initial attack. Our Helitack operation out of Glen Rock flew 37 missions, so 37 fires that they flew on, and again, they were very successful. After COVID and lots of things, we have been able to get our smoke busters, the inmate program up in Newcastle, back up and running, and they're on 10 fires this summer, which a little bit light for them, but it was where the fires were and what we were doing. The 537 account, which is the account that allows us to pay counties when they go on Forest Service on billable fires, where we can pay the counties, then we charge the Forest Service. Once again, was very effective also. We ran through about $6.5 million of out of state assignments that county guys were able to take, and we billed the Forest Service for. On the IIJA legislation, the Forest Action Plan, State Fire Assistance, and the Community Wildfire Defense Grants, we have those in place and are starting to work with the counties and our other cooperators on those grants. Our Good Neighbor Authority program, where we are able to do work on federal land, continues to be successful. We do have, that the legislature had approved, we did get the federal funding and have our statewide coordinator for GNA. We also have a forester on the BT, Bridger Teton, the Bighorn National Forest, the Black Hills National Forest, and we have 2 of those positions on the Medicine Bow. One of those is vacant right now, is a retired Forest Service guy that was in that position, and he decided to actually retire this time, so he is retired now. Currently statewide, we have over 15 ongoing projects with the different forests and with the BLM, and over half of those are timber sales where we're actually providing timber to the industry. So that program continues to expand and really thrive. One other thing I have, Mr. Chairman, is we've been working for about the last year with the Nature Conservancy on a outlook of what we're calling ecosystem services and the value of Wyoming's forests to the citizens of not just Wyoming, but to the country, since we have so many federal forests. The contractor that TNC's been working with have their preliminary report out and looking at 15 different ecosystem services, everything from water, watersheds and water quality, to recreation, to carbon, to forest products. The numbers they have right now show that the value of Wyoming's forests to the American public are somewhere between $22 and $28 billion a year is the value back to the American public. We're excited about that, even though most of our forests are federal, but I think it tells a good story why there's a need for public investment in the national forest system for moving forward. So we're pretty excited about that. Mr. Chairman, the only other thing I have is I did tell the board in August, at the August board meeting, that I'm retiring at the end of the year. That's still official. Human Resources and Retirement tells me that I have to have an official letter that I have
that I'm going to retire, and I do have copies for all of you today of my official intention to retire.
You stink. I was just doing it, ignore it, but now you put it out there.
So, Mr. Chairman, with that, I'd be glad to answer any questions that the board may have.
Are there questions, Mr. Treasurer?
Real quick, if you didn't have the beetle kill that killed all the trees, how much higher you think our contribution to the country would be?
Mr. Chairman, Mr. Treasurer, I think it would have increased some of the values. However, I think the consulting firm that TNC's been using is looking at forest as dynamic ecosystems and looking at towards the future and the future potential of the forest. So I think it would have made a difference, but I don't think it would have made it tremendous.
So they use like a 50 or 100-year run rate?
Yeah. And,
okay.
You know, the other thing I'd point out with their numbers, I believe, are low because they used forest inventory analysis numbers, which shows we only have about 9.5 million acres of forest in the state, where our numbers show we have about 11.5 to 12 million acres because we consider cottonwood riparian, some mahogany, mountain mahogany type areas as forested areas. They don't in their numbers. The other thing their report doesn't include is our community forests, the trees in towns, cities and towns, which we know have a significant economic impact as far as water quality, as far as temperature moderation, and all those factors. The other thing I don't think their report shows, and I'll say this because Mr. McGagn is in the room, it doesn't look like their report include the benefits of grazing on forest land. And so that's one of the comments I've sent back for them to include in their report.
Thank you.
Thank you.
Mr. Chairman.
Madam Auditor.
I hope we'll get a copy of that report when it.
Mr. Chairman, Auditor, when it's finalized, we are doing it in conjunction. Well, I should say the TNC is doing it in conjunction with us because we didn't put any money into it. So, but when the report is finalized, yeah, we'll have a copy of it.
It sounds very interesting. Thank you.
Yep, thanks. And Bill, I would say I appreciate that, and it would be interesting to look at the net liability if you don't manage your forest, because that would probably make the delta even larger. But the Fish Creek fire, do we have any data on that? That's the one that was south of Hewlett or Sundance, I mean?
Mr. Chairman, that fire, the preliminary report is human caused. I'm not sure what the exact cause was. It was predominantly on private lands, some Forest Service, and that was our most expensive fire of the year. And of the $5 million that we've committed out of EFSA this year, that fire is about $4 million of it. Part of that was the days 1 and 2 of the fire because of the homes that were in the area. We used a tremendous amount of heavy air resources on it, including the DC-10 VLAT was flying on that fire, and those get expensive real quick.
And timber and grass, or just timber?
It was, Mr. Chairman, it was timber and some grass on it also.
Okay, thank you. And we'll have a chance to say how much we appreciate you. I just, forgive me for you like putting the check mark on that. I just don't want to recognize it, Bill. So thank you very, very much. Any further questions? Okay, hearing none. Madam Director.
Mr. Chairman, that concludes the agenda today for the State Board of Land Commissioners.
Thank you, Madam Director. Thank you, Deputy Director. You and your staff have been great. Appreciate it very, very much. Thank you.
Move to adjourn, Mr. Chairman.
It has been moved to adjourn. Is there support? There's been support. Yes. Moved and seconded. All in favor signify by saying aye.
Aye.
That motion carries.